the introduction of private credit and things that don't work, like the constraining of private credit. I mean, the growth differential, one of the principal drivers for that is the availability of private credit. I'm going to take up some of your time with this because this is really important. If going into the financial crisis of 2008, you had 100 of credit in our system, and 70 of it came from the banking sector, and then you pass Dodd-Frank and all these other things, and you take that 70 and you take it down to 50, you need to make that 20 up somewhere, or your economy will shrink. In the US, that 20 was made up and more by alternative forms of credit. In Europe, it wasn't. The US grew, Europe did not. It's not much more complicated than that. And the Europeans, Draghi has flat out said it, we blew it. We constrained credit at a time when credit was really important for all of the most important emerging industries.
So private credit has been a force for good, is how you see it.
Credit is a force for good. Well-managed credit in an economy from as many diversified sources as possible, as long as risk is managed, is good.
And where we've seen a lot of that growth in the last decade has been in the private credit space. Now that you've seen the inner workings of that market and in your new role, in your current role, are there or where are the blind spots for regulators and people in your department?
You should always be asking yourself, where are the blind spots? And in the abstract, there are two places that you look, and then one additional thing you look for. The two places you look, and everybody in this room knows this, are liquidity mismatch. Am I borrowing short, lending long, and don't have relief if all of a sudden people demand their money back or prices change? Or is there hidden leverage, significant hidden leverage across a sector that when it becomes exposed, prices are going to drop precipitously? So you look for those two things, and then if you find them, you look for whether there's a transmission mechanism throughout the rest of the economy. That's the difference between what I would say is a sector risk and a systemic risk. And I think that's sort of the framework for looking at all these things.
And when we spoke back at the start of the year, you talked about this idea that there are areas of concern for you in private markets, even if most of the market is in good shape. Mm-hmm. What are those areas of concern for you?
What I think I said was, to the extent there are areas of concern, including ones that maybe I don't see or I'm not sure I agree with, I don't see a transmission mechanism through the rest of the economy. So, okay. And look, if people make lending mistakes, that's part of an ordinary operation of a market. If we overlent to software firms, okay, but maybe we underlent somewhere else, the market adjusts. That's the way we look at these things. What I did say, and I think the bank executives who criticize private credit, they have 2 points. One is they ought to be allowed to do it. As long as it's, again, operating well, they should be allowed to do it. The second one is on the marks and the transparency of the marks, we can do a better job. We can eliminate the question of whether people are marking something in book A at 100 and marking it at book B at 90 because 100 is good for them here and 90 is good for them there. That's something that can be eliminated.
How do you eliminate that?
I think you require a modicum of reporting. That's actually pretty easy to deal with. And on inspections, like the SEC does lots of inspections. They inspect firms all the time. They can ask those questions. And when those questions are asked, you better tell the SEC the truth.
But do you feel that when we talk about the valuation gray zone or issues with marks, is that a function of market stress as well? Is there elevated behavior like that when markets are difficult to navigate?
I think spreads are wider when markets are difficult to navigate. Everybody in this room knows that. The more volatility, the more uncertainty, the wider spreads are going to be. Particularly, unfortunately, academics look at this and think like a spread is a spread, whether you're trading 100 or 100,000. We all know that it's much different depending on the volume. But look, these are all good questions. I have no problem with these questions. I do have problem with the pearl clutching hysteria unless you have sort of identified areas of concern.
So, but let's get deeper into this valuation gray zone for just a minute. Where are the red flags where do you think are the red flags in that space?
No, but where you look is when you have a market where there's a bunch of participants and a large portion of them have it marked at, say, 75, and one or two have it marked at 95. Like that's a place where you say, okay, I need to ask some questions about the folks who are marking it at 95, particularly if they're making fees off it.
And is that a big area of focus? Because
I'm asking the question. Like I mean, to be clear, I'm asking my people to look at that question across the marketplace.
we spoke about this.
Shouldn't I?
We spoke about this a little bit, but there is this idea, at least in the defense bar, that anytime someone in your seat, in your department, talks about concepts like marks and bad marks and valuations, they feel it's more saber rattling than real action. They say it's extremely hard to bring any sort of valuation cases, so they wouldn't pay much heed to that. How do you respond to that?
Well, since I've been at the SDNY in the pre-IPO space, we've brought a number of cases where the question of, how are things being marked, and are they being marked, I'd say one place one way, one place another, is at the center of those cases. So we're doing it.
So you don't accept that criticism that it's going to be hard?
No, and if you look at, these are pending cases, but if you look at the cases in the credit space that are pending, I'll just mention them by name and then take a step back. But Tricolor, 777, First Brands, those are cases where they have traditional elements to them, but valuations are at the center of those cases.
When you say traditional element, you mean just accusations of obvious fraud, double pledging, where it's clear as day?
If you're familiar with those indictments, they have hallmarks of the past and some of the present.
You also seem to have a fairly open channel with folks in the industry, and when you talk about issues with marks or where there might be some problems, is the reaction that you get, are the leaders in the private credit space trying to steer you away from it, or do they see that as a good thing for you to focus on?
I'm going to say this. In all my time at the SEC and in my time in this job, I would say at the large, well-regulated, they also have the Fed and OCC. And the leadership wants markets to be fair and to function well. They don't want shenanigans. I mean, that's just not part of the. You don't last if that's what you have. So I think I get great support from the large financial institutions. And I've never said, this is really important to me, I want the information, and not gotten it.
Why do you think that's the case? That's because you hold all the leverage and the power here.
And I think, but also you said we have a dialogue. If you have an honest dialogue about these things, you have context for asking for them.
I guess one question that a lot of folks have is when you're talking about issues with marks or the kinds of things where you want to dive in to see if there are problems there, what is the difference between bad judgment and bad conduct? Bad conduct is perhaps where you come in. Bad judgment is just bad judgment.
No, that's one of the hardest things about being a regulator, about being an enforcer, about being a prosecutor, is distinguishing between incompetence and bad judgment and criminal intent. That is why, I shouldn't say why, that is one of the reasons why we have the type of reporting requirements we do in financial institutions, because those reporting requirements are designed not just to provide information about risk, not just to provide information about performance, but they're also designed to discipline you and show the difference between incompetence and ill intent. And I will say the financial sector is probably the best for that. The place where it's really difficult to find that, the difference between incompetence and ill intent, is the public sector. Because the reporting in the public sector is poor. I mean, we have huge problems in Medicaid and in benefits fraud. And we're getting at them, but the truly shockingly poor data makes that difficult. And one of the debates that we should be having, and now that we have new tools, AI tools, large tools, is let's get good data in the public sector. Let's have that benefits data available, because believe me, if that benefits data is available, we're going to find the hospice places that seek reimbursement for $500 patients, but only have 10 deaths. And they should go to jail.
Let's talk about the use of AI for a second. Are you actually seeing real applications for your department in being able to embrace AI?
I just gave you one. Like, what if you have good data around benefits distribution and benefits claims, using AI takes what might have taken an analyst weeks, an afternoon.
So what's the AI of choice at the Justice Department? Claude, OpenAI?
We're working on it. Look, the federal, back to the revolving door, the federal government needs to catch up on use of technology. We need to bring people in from the private sector. I think one of the glass half full things about AI is we were probably a generation behind already. Maybe we can just skip that generation and go right to AI.
One of your areas of focus at the SEC, at least you said...
No, I'm not kidding. Like, we should just hit Control-Alt-Delete. Get really good data and apply the new models to surveillance.
Have there been obvious immediate
Yes, already.
results, which is what you're talking about in
I would say we're in the incubation phase, but the incubation phase shows that the ROI on investing in good data and AI models to detect fraud is going to be huge.
That's a good talking point for Sam Altman and Dario ahead of their IPOs this year, hopefully. At the SEC, you talked about how you were a champion for retail investors. We're talking about the credit space, especially the private credit space, where we're moving away from necessarily a market catering to sophisticated investors towards a more retail-focused audience. When that happens, are you also interested in the action and the behaviors of the ecosystem of the market, which is not just the investment firms, but we're talking about statements made by fundraisers or third-party valuations, the actions of ratings firms? Are any of those of interest to you?
I'm interested in all of that, but I am interested in a fundamental problem, which is a well-managed pension fund has 10, 20, 30% exposure to alts, and alts includes private credit, and private credit largely includes investment grade private. So they have significant exposure to that. The best managers in the world think that's a good idea. A retail investor in their 401k can't get that product. They should be able to get that product at a low cost. That should be doable. And all the debate around this it's amazingly silly, because look at your 401k. If you're 30 years old, you're not allowed to touch that money without a penalty. That's exactly the kind of money where you should get the increased return from investing in less liquid instruments.
So when you have market jitters and you see the kind of headlines that we're seeing, when you see the kind of announcements out of a lot of these...
And I don't mean all of your money, but take a portfolio with theory approach. It's a better portfolio over the long term if you have that type of instrument as part of it.
So if that's the case, and when we see more and more retail investors embracing the space, and now we're in the second straight quarter of elevated withdrawals and gating issues, there almost seems to be a little bit of a mismatch on what they should have been told or expect from this product versus what's happening.
Let's just start with that true retirement money. So you don't have the withdrawal issue except in acute situations. And let's put a fiduciary in there. So it's a fund who's selecting that and making sure that you don't have over concentration. That should be a product. A target date fund like that should be a product everybody can embrace. I mean, I've never heard an argument to the contrary.
So what
everybody gives the corner cases.
So what explains the current state of, people trying to pull their money out when you're thinking that once they're in there, they should expect that it's long-term locked up money, and then you have these situations where companies have to gate redemptions at 5%.
Yeah, but that's not a retirement product. Sure. So I'm saying let's start in the retirement space. That's there. I think the market did learn something with those, which is what is the hurdle? 12%. Once there's 12%, then they
5%.
Whatever it is, and then you have to, that really means it's going to happen.
And so that you think is just more about how it's communicated to the investors, and there needs to be a better job around that?
Yeah, and investors understanding the behavior of other investors, and in a time when people are seeking withdrawals, how everybody else is going to act and what the end result is going to be. That was predictable.
I do want to talk about one of your signature initiatives, which is you've talked about this reformed whistleblower initiative with the non-prosecution agreement, which for the audience here is you're giving companies a chance to come to you and report bad conduct, where you give them basically a get out of jail free card if they report misconduct to you.
I love that characterization because it couldn't be more biased.
Why do you say that?
Because you say a get out of jail free card, they're handing us individual accountability, which is what America wants. America does not want a company to have bad conduct and the company pay a fine and the bad guys walk away. America wants a company that sees bad conduct to report it immediately to the authorities and for the bad actors to face justice. So this get out of jail free card stuff, it's
Non-prosecution agreement.
no, you give the company
Right.
non-prosecution agreement. It's not free. They have to cooperate. They have to turn over all of the evidence of wrongdoing by the individuals. It is so much more in line with what investors want, what people on the street want, and think about it this way, from a time perspective. Would you rather have them report to you and deal with the bad conduct? And it's not free. All restitution has to be paid. So the get out of jail free thing, I love when people say it, and I know you were saying this, but they haven't even read the policy when they say it. So let me just be clear. Company comes to us and says, we've had misconduct on desk A. These guys were front running. Here's all the evidence. We're going to cooperate with you. We're going to charge those guys on desk A, and they're going to face the consequences. The company is going to pay people back who were wronged. This is what any good company should do. And it's going to happen fast, as opposed to, you know what, there might have been some bad conduct on desk A. I don't want to call the regulators. We're not really sure. We open an investigation. It goes on for 3 years. Hopefully we get those guys. That is a completely unsatisfactory result for the marketplace. You have 3 years of litigation. You have uncertainty. Shareholders have uncertainty. So, I don't, and I've been doing this a long time. The companies who cooperate are the good companies. And when you set that in place, I can then say to the companies that choose not to cooperate, that see bad conduct on desk A and decide not to tell us about it, that we are going to take you to the woodshed.
Fair enough. That's an ominous warning. We're out of time. Thank you, Jay.
Okay.
Appreciate it.
Thank you. Thank you.
What a great look at how to balance the idea of incompetence versus actual malfeasance, as well as how to foster robust and fair markets. Up next, we have another fantastic panel, navigating cockroaches, geopolitics, and LMEs. I know that cockroaches always elicit incredible feelings for everybody. I'd like to welcome an amazing panel. Coming in, Matthew Rahmani of Perella Weinberg. We have Brett Klein of Sculpture Capital, Holly Kim of Glendon Capital, Susie Gibbons of Davidson Kempner, led by an ace moderator, Irene Garcia Perez. She, of course, will be joining us now.
So before starting with the discussion, let's bring up the question for the audience for this panel. Which is, what's the biggest risk to credit markets today? And then we will give some time to answer, and we'll pull up the answers at the end of the panel. So let's start with the conversation, right? Despite the war with Iran and the impact that it's had in oil prices, despite inflation, high interest rates, weak consumer sentiment, if you look at high-yield credit spreads, they're still quite tight. So what are the opportunities for distressed investors? Holly, you want to start?
Sure. I will agree with you that high-yield spreads are at their all-time tights, but that's for a good reason. With the advent of private credit, high yield has actually moved up in quality. They decided to take their ball and go home. So you are actually seeing historic tightening because about 60% of the index is now double B, one notch below investment grade. But where we are seeing opportunities, and the really great opportunities in credit opportunities really come when there's a high volatility and forced selling. We do have some higher volatility, but the real forced selling isn't there yet. And I will touch upon really quickly where we're seeing opportunities today. But what's really unique about sort of what this time in the industry and for the first time in my career is that there is a pipeline of defaults. Whether we have an intense economic cycle, whether we have a recession or not, we are going to have a default cycle because there is a pipeline of defaults that are already baked into the system from the what I will call LBO bubble from 2021, and that was $2 trillion of transactions in 2021 and 2022 in some of the most highly levered balance sheets. And there's about $165 billion of LME paper. That is some of the worst paper in the industry with 66 issuers. And even the super senior paper is now trading at distress levels, average price in the 70s. And that's $90 billion, and there's another $75 billion that's subordinated to that. So those are defaults that are ready to go. And when you have that level of default, you are going to have some forced selling in the markets. But in addition to that, there is a maturity wall that's never really come into fruition. It was actually one of the biggest boogeymen in the industry. Maturity wall is going to get solved. In this instance, because the refinancing market was so wide open in 2024 and 2025, we have an additional $500 billion of maturities in the next 2 years that need to be met. And a lot of those companies didn't refi because they couldn't access the market. So we're talking about a big sort of backlog of default away from any economic or dislocation from consumers changing their behavior from the oil shock or any other inflation-related economic inputs. But overall, where we're seeing sort of activity or selling today, we are seeing that the banks are in actually better position to take some losses. So they are starting to clean up their commercial real estate book. So we are seeing some decent opportunities there. We're picking our spots. Obviously, we don't want to be directly competing with the Blackstone real estate fund or anything like that. And then where we are seeing opportunities, oddly enough, and this has just come up in the last week or so, is cable. Cable issuers, you cannot ignore what has happened to cable sort of broadband providers, Comcast and Charter. If you just look at their multiples, they went from 10 times to 5.5 times. And when you are trading at 10 times, you get to put 4.5 times leverage on your books. But now that you're trading at 5.5 times, you're very over levered, and that's about $230 billion of paper out there. And there are there are two issuers that are kind of trading like they're about to go bankrupt as well. And I think that's being largely ignored in the markets. But that is an impending sort of industry consolidation / a day of reckoning that has to come as well. But I'm going to leave it to my other panelists to address the other issues.
Brett, what's your take?
Yeah, I'll piggyback a little bit on some of Holly's thoughts. First, I would differentiate between opportunities for distressed investors which are quite limited right now. There's not a lot of traditional high-quality restructurings or defaults that exist, but there are ample opportunities for opportunistic investors. And opportunistic investors are defined as those looking and willing to engage in complex situations for returns in excess of the traditional leverage finance spread. And that exists because at an index level, the market is very tight, but it's very tight because you have a completely bifurcated market. You have 50% plus of the market trading above par, and those are the haves where money flocks and floods in a very aggressive basis with very limited questions asked because everything is going perfectly well. And then the other half of the market, nobody's willing to engage or do the work and figure out if the company's going to be fine and going to be a survivor, but many of them are not distressed situations. They're just a bit out of favor, unloved industries, things like that. So you look at the geopolitical dynamic, and so you have areas like consumer finance, you have aviation, and to a certain extent cable, where these are viable companies, but you can get excess return without going through that sort of traditional bankruptcy restructuring process in many of those situations. And as a result, there's excess return and probably more excess return than you would traditionally get because it's in the have-not camp. And so I think there's a reasonable amount of opportunity in those spaces.
Thank you. And Susie, anything to
Sure.
add?
So at Davidson Kempner, we're global investors, and so we have teams that are very active in Europe and parts of Asia. And we do see that the opportunity sets really do differ across the globe. The credit cycles are different, the market structures are different. But because we're here in New York and we're talking a lot about US credit, I'll stick to that theme because there's plenty to talk about. I think as both Holly and Brett alluded to, there's a lot going on, a lot of different potential opportunity sets. The market is obviously very large, $4.5 trillion of levered credit, roughly equally split, a third, high yield leverage loans and direct lending. I think we agree that the coming opportunity set that we see is really concentrated in the leverage loan and the direct lending market. We sized what the opportunity is in those markets using fundamental credit data, leverage over 7 times, interest coverage ratios below 1.5 times, and we came up with a number that I think is pretty staggering, $770 billion, based on those fundamental credit metrics. That's about a third of the leverage loan and direct lending market. And in percentage terms, I think what really stands out is that percentage has doubled since 2019. So there's clearly something going on here in terms of the building stress that both Holly and Brett alluded to. And I think the reason it's concentrated in those markets is because that's where a lot of the LBO activity is, and those are floating rate structures. So they've been hit by the higher rates since 2022. Where there's opportunity, and we're seeing hints of it today, but it really, as both alluded to, it's coming inevitably, is that some of these capital structures, they were built in the low rate environment and they just don't make sense today. And so we think where there are, among these broken and breaking capital structures, there are in many cases really good companies. They just haven't had any excess cash flow to invest in the businesses. And the equity owners haven't really been focused on them because there hasn't been equity value. They've been focused on time buying. And so that's, I think, the future interesting opportunity that we see in the US is the direct lending market in particular, likely opening up to secondary transactions where opportunistic credit investors who have restructuring capabilities and will focus on optimizing these businesses can find really interesting opportunities. But we're very early. I think that's what we will see as a big theme the next few years.
We'll talk about private credit a bit more later. Matt, question for you. In the past few years, liability management exercises have become sort of a catch-all term for out-of-court workouts. But if you had to say between soft-touch transactions like amend and extend and more comprehensive workouts, including distress exchanges or even a change of control, and bankruptcies, where have you seen more activity so far this year, and what do you expect to see in the second half of the year?
So I like that you referenced like the concept that an LME is normally referenced as something, and restructurings are normally referenced as bankruptcies, and like the descriptions are important because I think like the lines are blurring in terms of what an LME means, what a restructuring means, and that blurring is happening because even in the context of like liability management activity, what we're finding are transactions that are involving, in some cases, greater haircuts, right, from lenders, or equity sharing from lenders, or transactions that result in ultimately lenders receiving the equity in the company if a milestone is not hit or if there's a future event of default. Or even, frankly, in some transactions that were called liability management, which could be an international venue to effectuate what is an equitization, right? Something like ARDA, something like New Fortress Energy, or Fossil, right? Those are things that you may find those transactions on liability management, data sets because they're out of court and being done through like international venues, but realistically they're equity-based transactions. The data itself will suggest, like, and if you look at some of the data providers that reference it, that LMEs, so to speak, in terms of how it's defined, are like somewhat softer this year, relative to last year at this time. Restructurings are, restructurings, i.e. bankruptcies, are up. And in part, some of that is because, let's say, 4 out of, I think like the 8 bankruptcies, let's say in Q1, the large scale ones were from like previous LMEs. And so there's just, by nature, and there will be an increasing amount of bankruptcies from LMEs over the past, couple of years, just given the volume of LME activity in 24 and 25. But I think that the descriptor is really important because, notably, if you're looking for like a trend in the types of transactions that we've seen, that we are seeing, and we're talking about now over the coming quarters, it's less about, again, like thinking about it as LME or restructuring, so to speak, and more so transactions that provide resolution to capital structure distress, like much more so than a couple of years, right? And so LME as like a solution to capital structure distress, well, maybe people, I think, entertained that topic over the past, or that concept over the past couple of years. There's just an increasing like recognition, and that from a investor perspective, that like LME, is not a means to an end. Like it is something greater has to happen, and that greater is manifesting itself. And I think things that are or maybe perceived as restructuring like, even though they're not LME. So the TLDR, the data is going to suggest that I think LMEs are down and restructurings are up. But like more interestingly, yes, there is the likelihood that you're going to see more of these equitization-like transactions, which can be called LME, but really are more like restructurings as we think about them.
Between the legal over-engineering of some of those transactions and the point that you were alluding to, the fact that several LMEs end up having to do a full restructuring or even a bankruptcy, would you say bankruptcy LMEs are losing their appeal? And I'm asking this question just 2 days after Optimum Communication disclosed a transaction that was quite complex to force creditors to negotiate probably an LME. But generally speaking, would you say LMEs are losing their appeal?
Well, I think it obviously is very connected to the first part of the question. And so I do think, or I'll posit, like the reason why we're in a world now where investors are so focused on not doing an A&E or doing an LME for the sake of doing an LME and kicking the can, so to speak, is because there's increased recognition that there is value degradation that comes from LME, right? That doesn't really, where there isn't a credible story as to what I'm extending to. And so, perhaps because lenders perceive sponsors of companies as not doing the deal away risk, or the recognition that most of these transactions, or a third of these transactions, are like ending up in bankruptcies. There is fatigue, and so even when we talk to clients and the way we market our business on the restructuring side, the discussions around like, oh, what can the company do? What can the sponsor do in the docs? Like what we think is going to happen without like more. A lot of that dialogue people don't want to have as much, right? It's more so like if we're going to find ourselves in a situation now where we know that we're going to be approached, right? Like what is the mechanism to ensure that we have a maximum amount of protection, that we are not going to find ourselves in a scenario where there's going to be a bankruptcy in 2 years, where we're not going to find ourselves in a scenario where we're just doing this as a stopgap to another transaction. And so as part of that, as I alluded to earlier, there are certainly going to be more transactions where, in the context of extension deals, equity can potentially be offered in the future in a frictionless way to lenders if certain milestones are not met, right? Like something like that has been called stock in a box as an example. Now obviously that in theory from a sponsor, from a company's perspective, is going to be like a last resort type of solution, and there's perception, it's the concept that is tied to fund life and other dynamics at the sponsor level, the willingness to put in new capital. But undoubtedly, the idea of LME fatigue, when we think about LME, is just like an out-of-court A&E, I think is very real. There's going to be a lot more focus on what are we doing to ensure that we're protecting ourselves. And that the answer to that question might be just let's restructure it now. But it's definitely a theme, and I'm sure the investors here will be able to add to that.
Something to that. Just lately, and this ties into the maturity wall, there's just so many maturities coming up in 27 and 28 that in bankruptcy, there's a 2-year look back on fraudulent conveyance. So the super aggressive LMEs, the board and the sponsors have to think a little bit harder about sort of leaving the company more insolvent through an LME transaction. So the conversations have changed markedly. It's not about I'm going to do these horrible things to you, creditor, if you don't do X, Y, Z for me. And the creditors, on the other hand, are trying to kind of get into that 2-year window. I'm seeing a lot of that, dragging your feet to get into that 2-year window so that the board has to think twice. So we see a lot more conversation around extension, maybe adding a little more equity, making it a little more creditor friendly for a traditional extension because they couldn't refi in the market. So buying themselves a year or two before they can go out in the market and
that's
refi.
that's going to be really interesting with software, where you have a lot of maturities in 2028 and real questions about that. So are we going to see a wave of LMEs later this year, or what will the nature of those conversations look like?
I think there's also a bigger picture element along with the LME conversation, which is, like everything else that gets overdone and abused, there is an investor dynamic, which is, I don't want to do this anymore. It's an experiment that has gone bad. And the creditor experience, the investor experience from the creditor standpoint, has, for the most part, been bad. And it only served the sponsors and the equity holders and the advisors. And investors are now saying,
No offense, Matt.
no more, like no mas. This has gone too far. And so there's a general pullback that says we're not really going to agree to this anymore. And also from a high level standpoint, where there is fatigue, and what has fallen out of favor is lending money and investing in secular declining, low quality businesses for a little bit of extra money, which you never get. And so I think that dynamic, along with the fact that LMEs started in the early days as something special you as a creditor could do, you can get some excess fees and collateral and return, turned into an exceedingly competitive dynamic where you proposed it to a company or you proposed it to a law firm or an advisor, and now they can put you in competition with 3 other groups, and it's a race to the bottom. And so that whole dynamic of, I don't really want to invest in this business, you're competed all the VIG away, and where are we going in the end with this has made everyone say, why don't you just file a company for bankruptcy?
Recovering the discussion that we were having earlier about private credit. Private credit is to blame or to thank for, depending on who you ask, for defaults not being even higher in the past few years. But the asset class has been facing a reckoning lately. So, Brett, do you think that private credit has lost its appeal for at least part of the investor base? And if so, what kind of opportunities do you expect to see, or what kind of spillover do you expect to see in the broadly syndicated market or even the high-yield bond market?
I think private credit hasn't necessarily lost its appeal, and it's an asset class that's here to stay. The idea of lending to reasonably high-quality businesses on a senior secured basis, and most of these funds with a modest amount of leverage, is a business that the investor base will continue to want to engage in. What has changed is there was likely an over-earning that was happening for a period of time, and competition has, taken some degree of that return profile away. The idea of low volatility in a private credit fund or private credit structure was confused with, I'll never have problems in my portfolio. Tech and software has exposed that those are different things, volatility and potential impairment, and over allocating to a certain space and getting over your skis has highlighted that risk. And so what's really happening is, I think the investor base is recognizing that what were potentially double-digit returns in private credit are several hundred basis points lower, but the asset class is here. It's generally liked by the investor base, but maybe in a different magnitude in terms of return profile.
I would just want to add on in terms of one of the issues that's manifesting with direct lending is that the underwritten leverage was higher than what people recognized. What we've seen in the data is just these EBITDA add backs have basically doubled over the last decade in direct lending. So what was a differential between actual earnings and adjusted earnings blew up to 2 turns most recently. And so that means that a lot of these loans, and even still we're seeing this, that looked like 45% LTVs were really 65% LTVs. And so I do think, to your point about several basis points lower, like what's going to start materializing is just this disappointment that the losses are going to be a lot worse than people think or expected, because the starting leverage is so much higher. And that's before the idiosyncratic issues like software. That's just loans on basic companies where there was too much optimism about potential synergies or cost savings, and basically the leverage was misrepresented.
And the impact to the public market is just more rational behavior throughout, because the little secret of the private credit and the public credit market is that in many arenas they are competing to lend to the same companies. The idea that private credit only has its borrowers and public credit has its borrowers went away over the last several years. They are converging or have completely converged. So borrowers go and they survey the public market and they survey the private market, and sometimes they go to the same lender in 2 different teams within the same organization. But as a result of rationalization of the private credit market, you're seeing that the public market is able to price risk and compete in a much more rational fashion, as opposed to competing against a complete flood of capital where it was hard to do anything because they just wanted to deploy risk.
I just believe in laws of physics. And so if you have been charging 200 basis points over your competitor, which are levered loans, for a long period of time, you're going to have losses. And I'm not saying they're going to be wiped out, but on a relative basis, the higher the rate you charged, the higher your default should be. And if the multiples are higher than you said, your loss given defaults are just going to be higher. The problem with private credit is that it just came out of nowhere, and it was such a successful marketing story, and they grew so fast that when you're in the growth stage, you don't have losses, right? Because you just financed them. You gave them the liquidity to avoid defaults for a while, and there was some bailing out of some of the marginal credits over the years. And there was a very specific period where the banks, remember Silicon Valley Bank? A lot of the banks got in trouble on mark-to-market of really high quality liquidity-based paper that they were holding because rates changed so much, long-term rates changed so much so fast. And they weren't lending as much for a few quarters. And that's when it was the golden period for private credit, where you really could get double-digit returns lending on a first lien basis. That has changed dramatically in the last 2 to 3 years, yet the rate hasn't come down at all. So you have to believe that they were taking some excess risk, especially relative to levered loans. Even investment grade has annual loss rates, right? And if you look at the advertised loss rates of these private credit funds, they're extremely low. It doesn't make any sense to me. And if indeed they can charge 200 basis points higher than levered loans, then something's got to give, and it probably is the multiple that you related to. And we ran our own numbers too, and we get 6 times instead of 4.5 times for levered loans. And the proof is in the pudding of the borrowers, right? You're KKR, you're a sponsor, you buy a company, and you hire an investment banker to help you with financing. Your banker will tell you to go get a rating. If you can get a rating of single B or better, you will get the best execution in high yield because they've gone up in quality. And if you can't do that, go to the levered loan market and see if you can get a term sheet. But no add backs, no funny business, no pro formas, and you'll get 4.5 times at most. And if you can't get a term sheet out of them, then you go to private credit. And they charge you more. These sponsors are smart. Management is very smart. They're not going to pay more unless they have to. So with the delay in the defaults in the private credit market and the fact that there should be higher default rates, who knows what the loss given defaults are going to be, but the indication should be that it should be higher than levered loans.
And how have the similarities and differences between private credit and syndicated workouts been evolving in the past few years?
Sure. So I'll start with the similarities, and I take a similar view to Matt that I'm going to refer to workouts more broadly as not just capital R restructurings, but really the nature of the workouts have been more time-buying exercises the last few years. So the liability management exercises in leveraged loans, and then in direct lending, the non-contractual picking of interest. And in both cases, it's due to the fact that companies can't meet their contractual obligations, whether it's the coupon or a maturity. And so the past few years for both those markets, I mean, it's manifested in different ways, LMEs and non-contractual pick, but it's been about time buying. And I think what's different, though, about the workouts in both markets is, as Holly and Brett alluded to, in the leveraged loan market, those losses have been realized on the back of LMEs. You've had haircuts that have been crystallized. You've had trading prices reflecting the stress. That hasn't happened yet in direct lending. So you've had the same sort of soft defaults, but you haven't had the losses flow through yet. What's, I think, interesting that people sometimes are surprised by is the fact that we're actually already in the 3rd year of an elevated default cycle if you think about default rates over 5%. That's including these soft defaults, these LMEs in leveraged loans, the non-contractual pick in direct lending. And so that's basically the longest elevated default cycle in over 20 years. And I think it just hasn't felt like other cycles because the financial crisis, the energy crisis, COVID, they've all been characterized by really short spikes in the default rate with immediate restructurings where the equity ownership changed hands. Here, it's been this slow bleed. As Holly alluded to, the pipeline for the big restructurings has been building. And so I think what's coming next, I think we've all been talking about it, is the phase of this elevated default cycle moving towards more traditional restructurings where the equity ownership changes hands.
Right. Matt, anything you would like to add in that?
Yeah, I mean, from an advisor standpoint, like historically, there's been like less for us to do in private credit land as it relates to restructurings, right? I mean, the less, let's say, lenders there are in a situation, and in the extreme, if there's one private lender, right, they can unilaterally, negotiate with the company. Certainly from the lender standpoint, from the company side, sometimes certainly companies and more frequently non-sponsor-backed companies will need help through a restructuring process in that way. Or there are situations where we come in, more so as a sale advisor, right, to the company or appointed by private lenders, like to work for the company, but essentially on behalf of lenders. And so, that happens. I think the question is like when we talk about private credit, is that a private credit situation with one lender, with 7 lenders, with 10 lenders, where there are secondary sales from more, classic private lenders to someone that might look like more of like a BSL? Were those private loans sold in a broader book? And so those are the types of questions that I think as private credit restructurings become more prevalent, certainly from an advisor standpoint, that's how we're going to question whether there's like market, opportunity there. I think, and I'm, curious from the investors on the panel, one of like the nuanced things about, certainly the direct lenders a lot of these teams are set up to own businesses also, right? They have like 20, 25 people, like workout teams at these direct lenders. And so, whilst maybe historically, you just, and some of it's just not in the news. You don't hear about a lot of like private credit, let's say takeovers, but there are a lot of them, certainly at the small and mid-market size. So, my question also like for the panel on this is, do you think that the perspective that, private lenders are more set up to own businesses, or they seem to have the infrastructure to do so on a relative basis to, let's say, XYZ $8 billion, opportunistic fund that may just have a couple of operational type people. So do you think that, we may find ourselves in a situation where, in this world where there's more restructurings, the funds like yourselves are set up to actually own businesses as opposed to, like, let's say private credit, where they are more likely, I would think, to own businesses and operate them?
I think for the private credit lenders, I agree. Just look at the pedigree of the organizations. Many came out of private equity funds, so they are operationally and staffing-wise in a pretty good place to own, do the distressed for control type investment. That doesn't, however, mean that their clients in direct lending Fund 7 are looking for equity in perpetuity. So I think they can do it, but it doesn't necessarily match the product in which the capital was deployed through. So that is a dynamic that you have to think through. In the same way, you actually could argue in some of sort of the evergreen type opportunistic funds, you actually may have clients who are prepared and invested in that. So it's a mix of both. And I think at the end of the day, when you make a loan, you're looking to make a loan, and your goal should be to get paid back at maturity.
Ideally, yeah. The implosion of First Brands and Tricolor last year generated a rather heated debate about lending practices and due diligence. First Brands in particular used a lot of add backs to mask some of the issues. Susie, have you seen an improvement in debt documentation or financial reporting as a result of those situations?
Well, I mean, based on the data that I was referencing earlier, we haven't seen it yet. I'm curious if others have. It still shows up when you look at new issue data that the add backs, especially in direct lending, they're elevated about 2 turns, which is about double what we see in the leveraged loan market. So I'm not sure that I've seen a flow through yet. It's probably early days. Curious if others have views.
We don't operate in primary markets. We're purely a secondary market credit opportunities fund, and so we're not really that involved in the underwriting.
I'm with Susie. You wouldn't say we've seen a wholesale change. Wow, look how good the quality of earnings suddenly is. For the most part, you have to enter every situation assuming they're trying to trick you, and you have to scrub the numbers top to bottom and figure out what's real and what's not. But there has not been a wholesale dynamic change.
Okay. Well, before we wrap up, let's bring the results of the poll. So it shows stagflation is seen as the biggest risk. Any reactions to that? Anyone would have chosen something that is not among those options as the main risk for credit markets?
I'm actually surprised it's not higher at the stagflation part, because, I mean, what is really going on? What is the current risk to the markets? We haven't really talked about it as much, but an energy shock usually does affect the economy. It always does. And it depends on how long the duration is. But the problem with the current energy shock is that we were expecting some rate cuts this year, and we were expecting some improvement in the move rate and housing-related type of businesses, and that's not happening. And then we have, government debt at pretty concerning levels. And so between interest rates and inflation, there is going to be an effect on consumers. And the first dollar of gas price increases has been absorbed by a lot of the stimulus in the tax bill, the one big beautiful bill. But the next dollar is on its own. It has to stand on its own. Wages have already gone negative. So we do believe that that is the biggest risk, and I don't know that the Fed can actually bail the consumer out because of the inflationary aspect of this particular crisis.
Okay. Well, thank you very much, Susie, Holly, Brett, Matt, for joining us today.
Thank you.
Thank you.
I wonder if more people would have actually voted for stagflation if it wasn't the stag part, if it was just deflation with some growth and then some more inflation put on top of it. Although notable how few people thought it was going to be private credit. And private credit is what we are heading to next. Going private, untangling the leveraged finance complex. Key question here, if that isn't the main risk, is this potentially a source of rejuvenation after a bit of a pause over the past couple of weeks? Joining is a fantastic panel. Nawe of Barclays, Christina Lee of Oaktree, Lotfi Karui of PIMCO, Susan Kasser of Neuberger Berman, all led by ACE moderator Nabila Ahmed of Bloomberg News. Please welcome them.
Thank you, Lisa, and good morning, everyone. So we have 30 minutes this morning to untangle the leverage finance complex. It's very ambitious, so we'll get right to it. Now, let me start with you. Barclays had its high-yield conference recently, and I feel like the conversation may have changed slightly since we last had you on this panel in London and in 2023. Love to start with what you're seeing in the tussle between the broadly syndicated market and private credit, and whether you're seeing private credit lenders as competitive as they were even a year ago.
Mm-hmm. Yeah, I would say it does feel like the pendulum has swung a little bit more to the middle. And in full disclosure, from Barclays' perspective, we have a strategic partnership with AGL on the private credit side. So as a banker, we're entirely product agnostic. So whether it's private credit or BSL, ultimately it's providing structured solutions for our clients. But from recent engagement with clients, we're definitely seeing signs of, from private credit providers, some retrenchment in terms of leverage. We're definitely seeing their credit selections being a little bit more stringent, and also from a spread perspective, pricing widening. So look, ultimately, I think there will be a new equilibrium being established between BSL and private credit, and ultimately, for majority of our clients, when they look at financing options, they are still considering private credit and BSL on a side-by-side basis. So as an issuer, I think they will still have the options both available to them.
Are you seeing private credit lenders being as competitive as before?
Maybe to quote one of the clients, and they said to me they felt some of the private credit are bidding to lose. So I suspect some of that behavior probably come from, it depends on who they are, probably come from people maybe have a slightly higher exposure to private BDCs. And look, I think in the end, some issuers are better positioned to raise financing in private credit, and some are better suited in BSL. So I do think ultimately those options are available, and it's still, they will compete with each other. So I think that competition hasn't died away. But some of where stretching leverage, for example, we're definitely seeing people start pivoting back to, when it comes to underwriting credit, the credit 101, which is actually focusing on cash flows, interest cover ratios, et cetera.
Susan, I don't know about pricing to lose, but what's your deal pipeline look like?
Yeah.
And how often are you saying no versus yes?
Okay, so I want to pick up on that observation. So it's important to recognize that not all direct lenders or private credit investors are funded the same way. At Neuberger, I'm managing a $25 billion direct lending portfolio. I like to describe my investor base as 98% institutional and 100% patient. At the same time, we're in an environment that is definitively risk off. So spreads are up by at least 50 basis points, leverage asks are down, documentation is tighter. We're averaging about a $10 billion weekly pipeline. That's off a little bit from prior year, but not by much, by 10%. So you would think this would be a period of great deployment, but actually our decline rate, I just checked, year to date is 98%, 98% decline rate. Normally it's 94. So that's actually, most of the time we don't invest money, but we're investing much less money year to date than expected, especially given the risk-off environment. So why is that? And I think it's because similar to 2022, when we went from a risk-on environment in 21 into a risk-off environment in 22, who adjusts the fastest? The buyers and the new lenders. Who adjusts less quickly? The sellers and maybe the private equity sponsors looking for financing. And so I think we're still all finding the new equilibrium, right? So clearly 50 basis points pricing spread is there, but is that sufficient? Should it be higher? And I think that's what's slowing down consummation. I think for private equity funds, they might be bidding on assets. Obviously, private equity funds are selling assets, but private equity funds can be very sticky about wanting to get a mark at or above where they've held it. So even if they're making a good return, if they're not making the return that they have the asset marked at, they might wait to sell. You know, they're not in a hurry. So I think that's what's slowing down deployment a little bit.
Christina, how often are you saying no?
Yeah, it's probably very similar to Susan, where it's been kind of an elevated rate this year. I think what we normally have seen when there's pockets of volatility within the financing markets is, one, deal volume comes down. And then what are the deals that are in the market? Usually those are the deals that can't have the patience. For example, they have an upcoming maturity coming up. There might be a liquidity need coming up, so they are forced to either find financing or forced to sell. And from a performing direct lender side, that's not necessarily in our mandate. And so we're likely going to pass on those deals. And so what we see in the market is lower deal volume, and then the deal volume that we have been seeing has been relatively mixed. I would say over the last few weeks in the mid-market specifically, we have seen an increase. And I think it's twofold on why we're seeing a mid-market increase. I think one, a lot of these sponsors are now looking to deploy the remaining dry powder in their funds. If you look at the vintage that they're in, they got to deploy it now. Two is it's a lot easier to do a financing package that's $200-300 million than $1 billion plus right now in the direct lending market. And I think they're saying, hey, the volatility is a little bit less in the mid-market. Let's try to see to either sell or get a refinancing done.
One area where we are seeing a lot of activity is AI data centers. We've got $3 trillion worth of financing that needs to be raised to build out the AI boom. Lotfi, what do you think the market's cap is for that? How much of that can investors actually digest?
We actually have a lot more if you look beyond the next 2 years. Look, I'll probably answer that question with a little bit of a macro perspective. I think there are 3 prices that need to stay at accommodative levels in order to sustain those enormous CapEx needs, and that's spreads, yields, and the dollar. The dollar, because this is set to make the U.S. an even larger exporter of financial claims, and you need to be able to continue to attract capital from foreigners. Yields, because it's the price that determines everything. And then spreads, I would argue that's where you've seen the adjustment happening already. Look no further than 10s, 30s curves for the hyperscalers. They've steepened quite dramatically, even though the rest of the non-fin universe has been flattening. And so the market is paying attention, both on the credit side and on the equity side. And you hear this argument, is this the late 1990s all over again? Maybe. The one difference, however, is that it feels like there's less complacency on the market side. The yield question is probably the trickiest one in my view, because these financing needs are happening against a backdrop of large twin deficits in the US. Central banks are not on the other side of that trade. They're not financing you. There's QT basically going on. And so what's the clearing mechanism? Logically, the real yield equilibrium levels should go up a little bit, and the term premium should have a new floor in my view. That doesn't mean that treasuries are not going to pay you off if tomorrow there's an accident in the cycle and we get a recession. That's a cyclical behavior. But from a structural standpoint, if this plays out as everyone is expecting, which is a multi-trillion, multi-year CapEx cycle that is funded in credit, yeah, there's a finite amount of savings in the system, and you got to draw down on those savings, and the real yield equilibrium should go up a little bit, and the term premium should reset to higher levels. Now, there's a zillion sort of scenarios around that baseline that you can describe. It can go wrong, it can go great, we'll see.
Now we've got, I think 20% of high yield issuance is supposed to be coming from data center financing this year. How active does Barclays want to be in this space? How are you thinking about it?
The data center related financing definitely has been a highlight for the high yield bond market this year. And I think 20% is year to date, and based on our visibility around the pipelines and anecdotes that we're hearing from the market, we think that this year, possibly 90 to 90 billion issuance into the market. So depends on how the broader high yield market is performing, that percentage could actually be higher by the time we get to the end of the year. I think obviously for us is a great focus. Two things I would maybe comment on this space. One is I would agree that it feels like the capacity is deep within the market, and there's certainly no sign of dissipating. And then second, I do think as this sector become more mature, the investors will start to rank across all of the issuers and trying to get a better sense of loan to value and pricing differentials. And then the third thing would be, as issuers starting to report on their construction phases, and to the extent if there is going to be any misses, I suspect that there will be trade-offs on the pricing from an investor perspective. So I think as a sector or a subsector within high yield, there's still more to come. We're definitely keeping a very close eye on that.
Christina, Oaktree has not been as active as some of your rivals when it comes to data center financing. Can you tell us why?
Yeah, I think that from Oaktree's perspective, we do think that data center financing and just digital infrastructure is a really large and growing opportunity set. We're just in the early innings of it. And from a performing private credit, the best we can do is give you your coupon back and your principal. So we're not saying it's a bad industry. We're just saying we need to be selective because we really don't know yet who the winners and losers of this competitive set is going to be. And we basically have a capitated return that will return to our LPs. And so we're watching it carefully and seeing it, but just knowing where we stand in the industry today, it's hard to say, hey, let's be really aggressive in this industry.
Of course, one part of the market that's definitely spooked a lot of people is software debt. So let's talk about that. We have a maturity wall coming up in the next couple of years at least $200 billion through to 2028. Lotfi, can you put into context the challenges facing some of those borrowers?
I don't think the sort of imminent refinancing needs is a challenge, which is good news. The worst thing that could have happened, by the way, is that we have a big refinancing cliff that would have probably triggered a wave of defaults. But I wouldn't take too much comfort from that, actually, because if you look at historical drivers of defaults, I think the inability of refinancing is generally not the biggest driver. You can pull forward that maturity wall a little bit and do things like LMEs or any other forms of out-of-court restructuring. And so to me, the big challenge is really fundamental in nature. I think it's super early still to assign a terminal value to a lot of those businesses. And as long as we don't have an answer to that question, I do think that software, whether you look at it in the BSL market, on the private side, in the equity market, it's kind of stuck in a trough a little bit. That valuation derating that we had, and it's super visible when you look at the equity market. It trades at the lowest premium relative to the S&P 500 ever, pretty much. I think that derating is going to be permanent until we have an answer to that question, which is what is the terminal value of those businesses? Now, what surprised me a little bit the last 3 months is that the sector still trades like one risk factor. We have not seen, dispersion picking up, and that tells you that the analyst community is kind of struggling with, identifying winners and losers. But as a sector, I think it's unfortunately still stuck in a trough.
So now what are you telling clients that have some of these maturities coming up?
I would say prepare for war and hope for peace. But I totally agree. I think it's still very early. So what I've said to the issuer clients are, first of all, you need to be patient, but be alert. Be very mindful of
market windows and what the other issuers are doing. And secondly, be overly communicative with your investors. So for example, we have seen, on quarterly investor calls, typically will be hosted by the CFO. We now have clients making sure the CEO can join those calls. So they are really maximizing every opportunity they have when it comes to interacting with the investors to make sure that their message is communicated across clearly. And we've sometimes seen some issuers getting their customers doing fireside chats and really talking about why the products that they're offering are, very insulated and very resilient. So we're seeing different ways of how issuers are trying to make sure they can be overly communicative with their investors. And then thirdly, I would say, just be very adaptable and be flexible, because I think that exactly how the refinancing will take place, it could be a combination of senior leverage needs to come down. It could be maybe the maturity needs to be shorter. It could be maybe the scheduled amortization needs to be more elevated. It could be that maybe we need to offer up some covenant. So it's unclear with all this bells and suspenders exactly what it takes to get to the right place, but ultimately not all credits are the same, and I think refinancing journey from A to B is not going to be linear. I think just be prepared, but it does feel like right this minute is still a little bit early. And for issuers who are resilient, I think they really need to deliver for the next few quarters when it comes to their performance and demonstrating their cash flow and then their underlying performance.
Susan, you're nodding vigorously here, so why don't you jump in?
Yeah, so I agree with everything that's been said. I also think that when people are focusing too much on the senior secured credit at the top, they're forgetting the equity underneath. And I'm not saying that the loan to value is sacrosanct. I'm not saying that at all. I'm saying that we're absolutely in a period of discovery. There's going to be dispersion. I would add that a lot of the private equity firms that own the businesses that we are lending to, and I suspect, Christina, you're lending to, their expertise in software is a franchise-defining quality for them. Private equity firms have tremendous advantages, including control, capital, and time. They are using this time wisely, exactly as you said, to develop AI strategies both on the defense and on the offense. Only time will tell where that turns out. And then when it's time to refinance, I think they have an interesting choice in front of them. Their best bet is most likely to be with the existing lenders. The existing lenders are sitting on a maturity, and so to some extent, it's their company, it's their option. The private equity fund can retain that company if they pay down the lenders, if the document is tight enough, if the pricing is good enough. So it feels like this is, exactly as you said, something to keep an eye on. Thankfully, not a huge issue right now, but people should not be painting everything with one single brush.
Let's talk about new money deals. Now, we've been hearing for a few years now that the LBOs are coming back. They were coming back last year, they were coming back the year before, they were coming back in January. Are they coming back, and does it matter if they don't?
So for our own conference, this is the perennial question that everybody asks, is when is LBO coming back? And I think when we talk about LBOs, in the most traditional sense, is the sponsor-to-sponsor auction pipelines. And to be fair, it has been fairly anemic for a few years now. And if you actually look at this year, the broader M&A activity has been very, very strong. If based on our data on an annualized basis, we think that this year is poised to be the second biggest M&A year, just after 2021. But the majority of the uplift has been driven by US corporates. So the corporate activity have been very healthy. I think corporates are sitting on very healthy balance sheets. The publicly listed ones have very healthy share prices. So their currency to go and do M&A is very strong. They're very well positioned. And also interestingly, when you look at the composite of deals, the markets very much favor the mega deals. So the percentage of deals that's more than 10 billion and 10 billion plus has increased significantly. So there is no shortage of deals, but the exit pace by the private equity clients, I don't think is as fast as they would have liked. And I think a lot of the portfolio companies within private equity, the way how they are going to exit is really going to be on a sector-by-sector, name-by-name basis. I think the traditional running an auction and one of the buyers will emerge. I don't think that is the case anymore.
I think it's also important to look at add-on acquisitions. Add-on acquisition numbers don't drive headlines, but they are absolutely an important part of deployment. I do like to remind people, though, that add-on acquisitions are an option. They're not an obligation. Just because you're lent to a company and the private equity fund wants to do an add-on acquisition, you don't have to fund that. You can also fund that at a different pricing structure. There's a lot you can do on the documentation. And in an environment with uncertainty, longer holds, need to get to the marked valuations or an excellent valuation in a grindy, inflationary, high interest rate environment, right? That's what we've been in for a long time now. Add-on acquisitions are a huge part of the playbook for the private equity funds, and there's a lot of opportunity there. In 2022, which again was the last recent period of risk-off activity, that was a much bigger component of our deployment than it is in a normal, heavy new LBO environment. And I would say that when I look at the statistics, even within our portfolio, add-on acquisitions are getting executed at lower leverage and at higher spreads. And it makes sense. The private equity sponsor is trying to do a definitive thing, and that definitive thing is acquire and integrate an acquisition. It's not, let's see what the highest leverage I can get and the lowest price that will clear is. So that can be a very attractive option for investors, even in this market. It doesn't make the headlines.
Yeah, I totally agree, especially in the environment where sponsors are forced to hold their portfolio for longer. So they have to go and look for different ways to drive value and value add. And one of the things they can do is to do bolt-ons. They can diversify their company geographically. They can drive a larger size. So I totally agree. I think when new LBOs have been thin, the bolt-ons actually have been a bright light when it comes to supply into the primary. And to be honest, this year, some of the volumes that we have seen on the M&A side are driven by one carve-out. So we're still seeing very elevated European corporate doing carve-outs where they are selling what they deemed as non-core assets in order to shore up their balance sheet. We're seeing very active, very high level of activity in take privates, especially in the UK, where US buyers are really genuinely seeing value in the European asset. So cross-border activities actually are relatively elevated this year.
Christina, where are you seeing the best opportunities in the market at the moment?
Yeah, I would say just kind of within direct lending itself, I would say the best opportunities that we're seeing is probably in, I call it really boring middle market companies. And what do I mean by very boring middle market companies? One, middle market because you just don't have that competitive dynamic with the BSL market, right? Because these companies are too small, they're just too small to access it. So they're always coming to private credit. Two, also with the cap structures being smaller, you're just seeing more kind of LBO activity start to pick up. And then third, what is boring? We call that old world economy. I think what we've seen from a thematic. And second is certain kinds of business services. I call them like you put a technician in a truck and they're doing a maintenance service, right? They're going on their routes, fixing HVACs, et cetera. And because all of that, why is that really, really popular right now? Because there's not really AI displacement. That's just been a theme. And so I think that's an area that you're seeing a lot of direct lenders focus on today.
And let me bring the audience in here too. I think we're going to pop up a little audience polling question here. Where is the best relative value in leverage finance right now? Your options are high yield bonds, leveraged loans, CLO structured credit, or direct lending. If you get your phones out, we'd love your thoughts. Get the QR code down and get typing. We'll come back to your answers a little later. Now let's talk about distress or rising signs of stress. Susan, what signs are you seeing in the market at the moment with that?
So stepping back for a second, I think that a lot of what is underlying the negative headlines that we see has to do with the fact that many of the statistics that people report are backward looking. So people report defaults and they report non-accruals, right? So non-accruals are at least more recent, but they're very much backward looking. And what people want in a risk-off environment, in a transition, in a uncertain backdrop, is they want forward-looking indicators. I'll give you one that's pretty easy to measure. What percentage of the coupon is PIK versus cash? There's no such thing as good PIK. There's only bad PIK. And so less PIK is better. Now, some of the other forward-looking metrics are much more subjective. And so you need to have an honest and transparent relationship with your manager to really understand what's underlying there. So, we of course have a watch list. We report on our watch list. We've added an AI watch list, which is separate, although there's some overlap, but not as much as you would think, with the underperformance watch list. We'll report leverage increases across the portfolio, et cetera. And then people are skeptical about how the marks work. I think also there's good and bad reason for that. You don't just want to look at what's the average NAV across a portfolio, because you also need to know how many loans are in that portfolio and how new are they. And you can also ask your manager, what's the lowest performing loan? What's the range? So I think you want to get a sense of all those things as well. And I do think if you're monitoring all those things for your manager, you should have quite a good sense of at least where they think the direction of travel is for the portfolio.
Christina, it's been a hectic year for private credit. What do you think have been the biggest lessons learned?
Yeah, I think one of the biggest lessons learned is I think direct lending has finally going through its first stress test. So I started doing direct lending in 2009. I don't even think direct lending or private credit was like even a term then. And it's just been up and to the right for the asset class. I mean, we are rivaling the size of the high yield bond market at this point. There's been a lot of liquidity, and there's really been really short term or not as deep pockets of volatility. And I think you're finally coming to see, okay, there is more dislocation. You're seeing non-accruals peak up, and you're seeing a bifurcation in managers, which I don't think you've seen over the last 10 to 15 years. And I think one of the things that is the biggest learning lesson is resisting the pressure to deploy and being selective, because I think that's where you're going to really actually see the returns be different across GPs. Because I think of even last year, the first 9 months, there was very little deal activity because of tariffs, there's noise. And then it was like FOMO happened in Q4 where everyone jumped in and pricing went down and leverage went up, exactly what we don't want to happen. And so I think if you're selective, now you're sitting on dry powder. I think from an Oaktree perspective, we were slower in deployment last year, but now we're in a better position because we're in a market now where leverage is a bit lower, spreads are a bit higher, and just better market conditions for the asset class.
Susan, you raised a new fund last year. What's it been like deploying into this market?
Yeah, so again, 98% institutional capital, 100% patient capital. I was at a conference recently. One of my state pension fund investors sat down, and before I could even shake his hand, he said, "You're underdeployed." I took a breath, and he said, "And we're happy with that." And I exhaled. So I completely agree with Christina that investors need to be honest with themselves, what they're asking from their managers, and did they select the correct managers for their goals. Capital deployment is the opposite of selectivity. It's a senior secured asset class, pick one. The other one that I like to remind people of, and this is a universal truth, you cannot get the illiquidity premium without subjecting yourself to illiquidity.
Lotfi, we've just got a couple minutes left, so let me ask you, what do you think is the biggest risk heading into the second half of the year?
Well, one thing I would add is that what's interesting is that those signs of stress in direct lending portfolios are actually happening in a backdrop of an economy at full employment, which is fairly rare. And so that tells you that the asset class is in some ways a victim of its own success. If you grow something by 7x over 10 years, well, guess what happens? Underwriting standards kind of deteriorate a little bit, and you start deploying as opposed to investing, which are two different things. The two biggest risks that I would keep an eye on are, number one, the unwind of the AI story. I think we're not immune to that, but it is really striking to me how imbalanced the economic value of the AI build-out cycle is. I mean, every dollar that the hyperscalers are spending goes to the semis. That's pretty much it. And if you look at the performance of semis versus hyperscalers and then the adopters, it's night and day. That is not sustainable. You need to balance that economic value across the entire AI supply chain. And then the second risk is really the current situation in the Middle East. I mean, it's striking to me how much of a disconnect there is between the facts in the Strait. Oil is still not flowing. That's just the reality of it. And then the narrative that you hear among market participants, which is aggressively embracing the view that it will all be fine. Maybe. I think we were very lucky going into the conflict that we had a lot of excess inventories. It's been impressive to see how flexible demand out of China has been in the shift towards renewable, but there's a limit to how much time you can buy, and you need resolution, and you need it soon.
That seems like a good place to end there. We'll just flash up the responses to the polling questions so we can see. There you go, CLO structured products and leverage loans, direct lending, high yield bonds. There you are. Thank you so much for joining us today, and we'll see you again soon.
I find it really interesting that high-yield bonds are the least attractive right now with potential rate risk, as well as everything else. A conversation about this, as well as what we were just hearing about, this idea that you could get a default cycle at a time of full employment and otherwise robust growth. The idea of differentiation at a time where people are talking about froth. Our next panelists are Christina Minnis of Goldman Sachs and, of course, Davide Stigliuzzo of Bloomberg News. To hash through it all, please welcome them to the stage.
Good morning, everyone. Christina, welcome to Bloomberg. Thanks for being with us.
Love being
this
here.
morning. Happy to have you. Lots to talk about.
There's nothing going on.
We'll talk about AI, M&A, a little bit about private credit. But before we do, I wanted to pull up the questions that we have for you all with the poll today. What's the biggest risk for the M&A outlook this year? We have 4 options: rates and inflation, the election cycle, AI disruption, and geopolitics. We'll leave the code up there for you to vote, and we'll come back to it later.
I don't get to do it?
You can do it live. You can do it live in a little bit. But before we kind of get into some of these topics, I kind of wanted to get, Christina, your take on where the market is right now. We are on the verge of the largest IPO in history with SpaceX. It was a record equity offering for Alphabet.
We had the largest last night, equity raise.
Equity raise.
Soon to be eclipsed by. Yeah.
So lots of excitement about the tech sector for sure. Credit spreads very close to their record heights. And then if you look at the world out there, still war in Iran, concerns about stagflation, concerns about the health of the U.S. consumer. So how do you make sense of that? And what's your read on the market?
Well, as you said, the markets are incredibly strong across every market, with the exception of leveraged loans. Everything is up, right? And it's tightened in dramatically. Loans are still down marginally, in large part driven by the disruption that we saw earlier in the year in software. Structured products are up 15%. High yields up 35%. IG's up 22% in volumes, right? And so there's this tremendous amount of activity, in large part being driven by this investment in AI and hard assets. I think one of the key takeaways from what happened last night, in our view, is number one, just think about what that says about the belief in what AI is going to do for the world, and the belief in the upside and the returns that are going to come from AI, to issue that amount of equity-related capital, in addition to have one of the most smartest investors in the world substantiate it, have the transaction be upsized, and then have the transaction effectively executed at a very, very modest discount. And this morning, the stock is trading well. That, to me, is a real snapshot of what is really going on, which is, yes, we can look at oil prices, we can look at geopolitical situations that make us all quite nervous. I know we looked at the election cycle. We can come up with a lot of issues, right? But there is just a fundamental generational investment in something that I think is really seismic, that is really driving the markets and driving also CEO confidence. What I found fascinating at our high yield conference last week out in California, Tim Ingrassia our vice chairman, global head of M&A, or has been global head of M&A for years, showed a chart of CEO confidence pre the war in the Middle East, post. It's exactly the same. You look back at the invasion in Ukraine, you look back at COVID, CEO confidence dropped precipitously. That's also just a very interesting stat of what people are thinking about their future and why M&A is up, almost 40%. IPO, we can talk about the IPO volumes being up, but even though sponsor activity is quite low, still it's down about 4% year over year, sponsor IPO volumes are up almost 40%. So you've got a lot of market statistics to say there's a lot to be, pretty, excited about, tempered by inflation, what's going on with margins, and then of course, to your point, there's a lot of uncertainty geopolitically in the world.
On AI, obviously, this is like a historic moment, as you described it. I think you talked at Milken about the opportunity for this build-out to kind of rely on different markets, public and private. Is there a sense of what that will look like sort of long-term, and any concern in terms of the pace at which that capital can be deployed in all these different markets?
I think at Goldman, one of the reasons why we set up the Capital Solutions Group 2 years ago and then launched this alternative origination group that I sit on top of is because we see the opportunity set across all these capital markets extraordinary, and they're innovating and developing. And in certain ways, it's giving us tremendous confidence that when you think about these numbers, one of the Goldman Sachs research numbers for AI investment over the next, I think, 2 years, 25 to 27, is 1.15 trillion. The big five are doing, I think, 600 billion this year. And you start to get a little concerned about, are these markets robust and big enough to handle what we see inside of Goldman Sachs across our platform? And we put these businesses together for a reason. They don't sit in different divisions. Structured products, IG, structured IG, leverage finance, all those products sit on one floor, actually, including risk management. It's because we see all the markets evolving and stepping up and innovating, and many of them converging. That's the other interesting point. They're not dark lines anymore between these markets, which is really exciting from a distribution perspective. So we sit here and say, you can create case studies that would suggest, are the markets big enough? Are they robust enough? So far, what we see is tremendous size of order books across all the platforms. And yes, there is dispersion. There are things to be concerned about. The prior panel around private credit and some of the challenges there, 100%, there is dispersion. But when you think about this AI investment, it is generational, but it's also being very well received by capital formation, both in the US and globally.
When you think about the development of the technology and the power to support it, it feels like ultimately this is a bet on maybe a handful, a dozen hyperscalers, companies that are developing these AI models. How are you managing concentration risk in that respect?
It's interesting you say that, because sitting where I sit on Capital Committee, the number of companies that are coming through our system that I would admit I haven't heard of. It's not just super concentrated. Yes, there's concentration. But again, there's a lot of innovation going on around power, energy, distribution. The derivatives of all this investment is filtering through the economy. And so, yes, it's concentrated. Yes, we're concerned about risk, and we mitigate our risk pretty carefully at Goldman Sachs. I'm sure other banks do as well. But it's spreading into the economy in a way that I think is very constructive and will be absorbed by many more companies and a lot more innovation. I'm telling you, the number of companies that we are now trying to develop a relationship with just in the US is extraordinary. It is not just the big five.
Could you give us a sense of what sort of your pipeline is like, and how much of that is kind of accounted for by AI and AI-related deals?
So, a couple stats. The leverage finance forward calendar is one pipeline that we look at, right? It's down to mid-30s from 70s, so that's lower. Obviously, I'll call it the AI-related pipeline around structured IG is up significantly. And And you can see that in high yield issuance this year, 20% of high yield issuance is AI related. That compares to 12% in IG. So again, last year there was very little being done in high yield in around the AI ecosystem, and now it's accelerating. So, we see robust M&A pipelines. We see robust, I'll call it AI-driven investment pipelines. I mentioned the sponsor backlog is still light in terms of sponsor-to-sponsor transaction. I think the prior panel talked about that. What is driving M&A and driving sponsor activity is take privates. It's up almost 37% year over year, as well as, I'll call it, portfolio restructuring of large corporates. We did a transaction this week for a large company that split off a division that was non-core, LBO, B2B, nice company. That loan priced at SOFR plus 250, almost at par, B2B. So that just, again, shows you, there are big pipelines, and there's a lot coming, but there's a lot of capital.
I feel like this might be a good time to come back to the results of our poll on the risks to the M&A outlook. Well, pretty clear answer.
What I would have said.
Rates and inflation, 57%, followed by geopolitics. Elections really trailing behind. Would you agree? Or what would have been?
I would have picked rates, and I would have probably gone rates, geo, and I just don't think AI is a risk.
Tailwind. What is the biggest concern around rates? Because obviously you're in a business where you're making underwriting decisions today, and you have to have a forward look of at least a few months.
Yeah.
Is the challenge here that the economy will get in a place where actually rates will need to go up?
Our position at the firm as of now is we're calling still for 2 cuts, one in December and one in the first quarter. But that is the concern. And I think sticky inflation, slowdown in growth concern, yes. I think we've got a 2.4% global GDP for 26, fourth quarter over quarter in the US, I think we're 2.1%. So we still see growth as being reasonable. But yeah, I think, inflation and high rates drive up cost of capital. Obviously, that will put a bit of a ceiling on M&A. It obviously affects sponsors significantly. But yeah, that is what we're really keeping an eye on. Our house view is still on the 2 cuts.
In terms of M&A, you mentioned IPOs. To what extent could this finally provide some relief to private equity sponsors who've been looking to exit some of these investments for a very long time? And how sort of well distributed is that sort of market opportunity?
Well, again, sponsor IPOs are up 37% year over year off of a very low base, but still they're up, which is fantastic. And I think it's an incredibly important mechanism for DPI. So that's very constructive. And obviously the equity markets are very strong. I think we have a lot going through the pipe right now in the next couple of months. And so I think in the next couple of months, I think most sponsors will be watching carefully. Those that got out ahead of these large transactions, I think, are relieved. Mm-hmm. But I think we're hopeful that these transactions they go well, they're absorbed. And we see a really robust, third and fourth quarter for sponsors. They have, $6 trillion of assets that are sitting in their portfolios. And, it's, if you look at the vintages are at the point now where it's time, right? Yeah. So I think we're hopeful that M&A picks up for sponsors. I think it will. I think the one dampener could be this rates and inflation perspective.
Yeah.
But we're cautiously optimistic that between the strength in the IPO market, once I'll call it the busy summer season comes through, it'll be an opportunity for them.
There's SpaceX, Anthropic, OpenAI, some of the names out there. When it comes to deal vintages, I think there was a comment made earlier in the distress panel about sort of the LBO boom bubble of 2021. That is an area when we ask people about what are you concerned about in terms of maturity walls and refinancings, a lot of deals, many in software, many financed by private credit in that sort of vintage that will need to be refinanced over the next few years. How manageable is that maturity wall?
I think it's quite manageable. It doesn't mean that every company will be refinanced, but I think there'll be companies that are easily accessing the BSL market. In fact, just yesterday we went through a list of quality companies that are sitting with, I'll call it 450 to 550 over type capital structures, where leverage is reasonable.
What is reasonable?
You know, it depends on the sector, but let's call it, you know, sub 6%, something like that. And they have really good access to the BSL market. I do think there are probably some quite levered companies that maybe have not performed as well. That there's going to have to be some strategic capital coming in. And we're starting to see that. Many firms, including Goldman Sachs, have raised, we'll call them strategic opportunities funds. That's probably one of the most interesting opportunities we see out of Alternative Origination Group at Goldman Sachs. We've launched recently private capital markets, which my partner Akila Rahman is running, that is focused on identifying those companies that need more equity type capital to be able to infuse into a holding company structure, to de-lever the OpCo, to enable the OpCo to get refinanced. And I think that's a really interesting opportunity for our own asset and wealth management, and also our clients. And that's why we've set up this new, we call it PACM, but private capital markets.
Got it. Does that include preferreds and
Yes.
structures like that?
Mm-hmm.
Okay. In terms of software businesses, obviously a lot of concerns out there. Where is the bar right now for underwriting an LBO in the software space?
Ooh, that's a tricky question. I do think it's possible to do that. I think if actually we were looking at some stats this morning in terms of how public software companies have traded, and a number of them have traded back up pretty meaningfully from the sort of baby with the bathwater that occurred in the beginning of the year. I think for the right sponsor with the right asset, and we'd have to do a lot of diligence around moat, et cetera. But you heard what the CEO of NVIDIA said I think a couple of days ago about this could be an accelerant for software, right, in terms of what this means for software. So I do think we're coming out of the freeze period into a period where it's possible. I know, our own risk tolerance at our firm is we want to support our clients. So
does that require less leverage, more equity, or a different structure?
All of the above.
Okay.
All of the above, for
right.
sure.
I want to talk about private credit. I know Goldman has done, private investing in private markets for a very long time. But I'm curious, what do you make of the past sort of 6 months or so and what's happened to that asset class in terms of concerns about redemptions, underwritings, the handful of loans going from 100 to 0 in a very short period of time? What do you make of that?
I've been in this business a very long time, so I'll date myself. I was around the last the October crash, so that gives you a sense how long I've been through these markets. And October '87, in case any of you in the room aren't old enough to know what that means. Probably a few of you don't. So I've seen a lot of cycles, and I would say, I'm sorry, one more time, what was the?
Oh, just what you make of this past 6 months. What have you learned
private
from
credit.
this?
Sorry,
Yeah.
I just lost my train of thought thinking back to October. I think private credit is an incredibly important weapon for corporates and sponsors, and it's a really important market. It's a couple trillion. I think all of the agita has been around the $400 billion that sits in BDCs and retail. Right. That's an important part of the market. I think there will be have and have-nots in that part of the market. I think it's all about credit selection and your underwriting standards. I think, at Goldman Sachs, we've always had a very rigorous underwriting standard. I think you saw in the first quarter our redemptions were slightly under 5%. I know there's a lot being written about redemptions in the second quarter. But I think that market is a very important market that is going to exist and move forward and coexist along the BSL market. And we're very committed to it. And I think from an investment opportunity, actually, I didn't know, what was the answer to the question regarding where would you invest, the last panel?
I think CLO was the top.
Okay.
Yeah, best relative value.
Yeah. I actually think in private credit, there's also some really interesting opportunities now as well, just because there are very good managers and there are very good assets, and there are those that aren't. So I continue to be quite constructive about private credit. I think our partners are as well. But of course, we've got to work through some of the portfolio challenges. As you pointed out, there's been some very challenging underwrites. And I think some of the 21 vintage that are in private credit, I'm guessing there'll be some more challenging credits there.
So a few more Pluralsights or Medallia potentially out there?
I mean, that was a very robust start in the market. And I think there's probably a few more of those. But again, moving forward, I think we're very optimistic. Again, we're investing there. We're raising funds there. We think it's a really important market.
Great. I think that's all the time we have. But Christina, thank you so much for joining us this morning.
Thanks.
Thank you, everyone.
Time for coffee. So if anyone wants coffee, now is the time to do it. We're going to take about a 15-minute break, but do come back. We have some wonderful panels coming up afterwards, including a one-on-one with Golden Tree founder and CIO Stephen Tannenbaum. We'll pick it up with that. We're also going to be speaking, of course, with Scott Goodwin, joining my dear friend Danny Berger. Do not miss all the incredible panels, as well as what to look for 2026 and beyond. Thank you so much.
welcome back to the stage Lisa Abramowitz.
Welcome back. Now that everyone's had some caffeine, for our next conversation, I am incredibly excited to speak with Stephen Tannenbaum, who is the CIO and the founder of Golden Tree Asset Management. He's one of the biggest distressed debt investors. He started his career at a mutual fund at Mackay Shields and has come and grown into a fund that has really defined a lot of trading strategies and innovation at a time of great nuance. Please welcome to the stage, Stephen Tannenbaum.
Thanks, Lisa.
I'm excited. I want to start actually with something that you mention a lot, which is you'll say, well, when I was at a mutual fund,
Yes.
and I think there aren't many hedge fund managers who bring up their mutual fund experience. Most of the time, they want to bury that. Why do you bring that up?
First, it was a great experience. You tend to, first, most of the money that's buying is having a similar strategy, which is, or a similar approach, which is you're evaluated versus an index. And it also is very competitive. There's hundreds of different managers out there. I remember when I started at Mackay Shields, we were 89 out of 91. And within 3 years, I was very proud we got to be number one. But that's a lot of people to compete against. And you get your scoreboard every day. But more importantly, strategically, there was the mindset of why do people buy, why do they sell, and can you front run that? Can you predict if the premise, if you're thinking of investments as maybe as short movies, and how's a movie going to end? And if your premise is if this happens and this happens, who am I going to sell it to, and why are they going to buy it? And so, part of that could be liquidity. Part of it can be the stats. Why isn't somebody going to buy the 4 times levered software company that's growing at 11%? Sure, they're going to be upset that they didn't buy it at 20%, but it was 5.25 or 5.5 times leveraged back then, and the mindset was different. So I think that, and if that looks attractive, for instance, just using an example, to what else is in the market that's yielding 10% or 9%, there's going to be enough takers in that. So having that mindset's always been attractive and helpful. There's also the, you look at something like COVID, and okay, how are people going to behave? There was usually, I remember in mutual funds that when people got redeemed, they would sell what they could sell quickest, or what was most liquid. I always tried to sell my semi-liquid product because I know I could never sell it in another week if this continued. So there's just different strategies to think about.
So if you fast forward to now,
Yep.
at Golden Tree Asset Management, how do you perceive the mentality right now in the masses or in the funds that you go up against?
Sure. So there was a bigger question we were talking just a few moments ago about the perspective on credit, particularly total return credit. And there's probably frustration because some other asset classes, particularly equities, are participating significantly, and credit, broadly speaking, is in the low single digits. So there's frustration and anxiousness. How do I capture returns? Against that backdrop, you have great current yields and still value when you subtract out versus defaults that justify being in credit.
Just to have everybody participate, this is a great time to bring in our question, which is how you're positioned in credit for the remainder of this year. And I would love for you all to weigh in, defensive, neutral, or risk on. From your perspective, how are you positioned? I mean, right now, do you want to take more risk? Are you looking for yield, or are you looking for defense ahead of greater opportunities?
So when we spoke in January at Davos, I mentioned how the setup was poor for credit and good for equities. Historically, when you've had stretch valuations in a mid-cycle where the economy is expected to grow at 2% or better, your returns in credit are less than the coupon. And that's exactly what's happened so far. In contrast, usually that's a great environment for equities, and that's what's happened. And even if you look at the equal weighted S&P, it's certainly beginning to catch on. So it's been a more broader rally, particularly the last few weeks, even in the face of Iran on again, off again conversations. Credit has still languished, and we expect that to continue. Now, that's not to say that it can't have a better second half, but I do think there's some pockets of opportunity. But this is historically a tough time to be in credit in terms of in the cycle.
Because of inflation and growth, that doesn't really benefit the instruments.
It's just how it's priced. It's priced as if defaults are going to be low, and that the corporate earnings are going to, and that they're more likely to disappoint. You're not getting paid to increase corporate earnings or for earnings to surprise on the upside, and you're being heavily penalized if they surprise on the downside. In the equity market, there's still some acceptance or excitement if you're taking up numbers.
There are some opportunities, like
Yes.
you said. Where's the distress? Where are you finding them right now?
So it's very situational. There's the expected distressed, which is in software, where the business model is getting called into question. Then there is also in telecom, another business model that's getting called into question. And there is an interesting relationship between the public equity, as you look at a Comcast, I think that's hitting a new low as we speak, a 52-week low. If not, it's certainly close to that. Charter's probably in the same camp. Cable One in the same camp. But yet some of the debt isn't. So I think that's kind of an interesting relationship. The debt and what happened, I guess, recently with Altice, with threatening a transaction. I think it's all a ploy for negotiation, but it probably brings people to the table sooner if it works. It's the same team that brought you Bausch, and we respect them an awful lot, but it kind of went nowhere when there was a bunch of I guess, potential transactions being contemplated that didn't get to the finish line from the equity.
So playing the debt equity structure in creative ways is one
Right.
way that you're playing with it.
Right, and within industries. I think the equity in cable is much easier. It's hard to see that the equities don't work, don't work, and the debt works. So I think that relationship's is kind of interesting. I'd say the same thing in healthcare, which seems like it's been a source of funding for technology stocks. And there are certain companies like Tenet, which strike me as very reasonable value. Sure, there has been some volume issues, but the valuations seem very credible, top-notch management team, and I think the equity market, the credit markets would finance the entire market cap.
More broadly, you started by talking about the frustration felt by a number of credit fund managers, because right now, this isn't an asset class that tends to work that well or give that many, that give outsized returns, given the scenario we're in. And yet people are pouring trillions of dollars into AI infrastructure. Does that worry you, excite you for the potential down the line?
Well, when you look at, the devil's in the details in terms of what the terms are. But when you look at who's backstopping it, they seem like good credits. And people tend to think of 2 and 3 years out, not 5 or 10 years out. And it looks like for 2 to 3 years out, you're getting overcompensated for the risk. On the other hand, you're dealing with terrible technicals. They don't seem to run out of product. And I think even this Google financing is suggesting that they want to make sure to be out in front of the financing in terms of the equity. And there's almost, or not almost, there is an arms race going on. And the issue is, will the infrastructure investment be justified, or will this be more like underwater cable, which was a good thing until it wasn't?
Do you have a take on that? Are you embedding a sort of thesis into your investments?
I'm somewhat agnostic, but history would have a bad record in terms of overinvestment for industries that have very high payouts, whether it's riverboat gambling to something like undersea cable. So, it's not a great precedent, but there's an argument that, I understand the arguments now, and I think our view is to be very deliberate to have additional assurances by the users that they're committed to these projects.
Would you rather invest in the high yield part or the investment grade part with the all-in backdrop, the idea that it tends to be lower duration, shorter maturity in the high yield, but higher risk, investment grade, longer duration, but tied to very reputable
So my guess is at different points in this funding, you're going to get high yield type of spreads in the investment grade market. So the issue is, what you do in between them. So I think it depends, on the pricing, but I think you'll get in at least every other stretched or overfinanced industry I've been part of, you usually have been able to get excellent protection with below investment grade pricing at some point. So now, what do you do in between there, is the issue. But it's going to get there at some point.
So you just dance in cable and pick up some distressed software and wait to invest in this area until it falls out of bed?
No, because if it's 2 or 3 years, that's a lot of return to give up. But to be deliberate about what you're getting versus the opportunity of what you might be getting. And I'm incredibly fickle on these topics, so I could, in a month or two, could just have a different perspective with more evidence.
How do you remain nimble at a time when you're going in and out of sometimes less liquid instruments?
First is you got to assume you can't be nimble in less liquid instruments. And lower prices brings in illiquidity, higher prices brings in confidence. So that's kind of the way the credit markets work. Just trying to ask as many questions and focus on what we think are the key variables. In something like AI, you can be overwhelmed by so much. So to try and look at some of the larger issues and just focus on that and be deliberate. Because there's so much supply, the idea of you're going to run out of opportunities isn't a real, that's not realistic. There's going to be something to do in this space, particularly as it continues to be successful.
Right now, would you rather be in public securities or private securities, just as a rule? I mean, in terms of the interest, the demand.
So when we look at asset classes, probably the asset-backed asset class, we find the best value, which is a private asset class. So we're finding good value there. In private credit, there's some of the more anxious capital, the open-ended private credit funds, are out of the market. So that leaves the funds and other players in private credit who are more deliberate, being the main buyers of private credit. So we're seeing good value there. We're seeing good value in some of the out-of-favor sectors, which is always the case. I mean, by definition, out-of-favor sectors are at discounts. But so I'd say it's eclectic, but we certainly are seeing better value in private credit today than we've seen in the last 24 to 36 months.
Are you getting paid for the illiquidity premium?
That's always after the fact comment. But it seems like you're getting better paid. In the absolute, when I think of things, I think it's, if I were to say out of 10, maybe a 6, 6.5. So it's above average, but not by much.
Right now, we're looking out for a year where a lot of people keep talking about inflation and inflationary risks, and this is one of the reasons why credit hasn't been as much of a sweet spot. How do you price that in? I mean, at what point do you just start to increase the sleeve of equities and create some protection on the downside and kind of hope for the best with a couple of security selections?
Inflation is probably the biggest risk in the market. And it's impacted, because it's impacted rates, much more credit than it has equities, which I'm surprised at, but it just is what it is. And if you look in the 70s, there were equities did better than credit. So, if you're looking at a bad environment, at least that's one example where equity outperformed credit. It's very much data dependent. It's also what's going to happen with the war. If you look at one of the big surprises so far this year is oil has been relatively calm in relative to what expectations. Most people thought if you got past Memorial Day, you would be 125, 135, but yet we're in the mid-90s. So I think it's, that's a factor that seems to, be developing. So it's hard to, have a line, to draw a line in the sand, on that.
This is cognitive dissonance every single morning. We talk to a lot of people, and we were speaking with Mike Wirth of Chevron the other day, and he said, we're going to end up with shortages. If this keeps going in the next couple of weeks, we could start seeing shortages in the United States. Diesel inventories are at the lowest level since 2003. And then you get an equity strategist on, a credit strategist on, we're not looking at that. That doesn't matter. How do you think about that?
So I kind of process it a little different, is how are equities pricing this? And equities seem to not be pricing the futures curve. So on the strip curve, it's just, so oil service, sure, Halliburton's having an excellent year, but when I look at some of the mid caps, very much pricing in, I'd say $70 to $75 oil. And when we see the M&A market in oil services, and we have a company that we own more than half of that looks at the M&A market and has bought a few companies in the past 12 months, and that market hasn't changed that much. So in terms of levels and pricings and multiples and expectations, so we see regardless of what people are saying, how they're voting with their feet, they're still very cynical of how long this will last. And that's probably, it seems like a better opportunity that it's going to be higher for longer than what's in the market.
So in other words, buy mid-cap oil names.
Yeah, and suppliers, but also when you're thinking about oil as an input to your companies, and I'm thinking as a portfolio manager, okay, what should we be assuming in terms of whether it's in building material products, and which oil can be an important input. What does it mean for inflation, et cetera? My guess is going to be higher for longer.
I want to pull up the results of the poll, and unfortunately we didn't have an answer to the poll of just frustrating. But the answer was, how are you positioning credit for the rest of 2026? Not for ultimate frustration, but neutral, 42%, defensive, 31%, risk on 27%. Does that surprise you?
So I look at it as almost 75%, 73% of people who are like, yeah.
What else can you say?
Yeah, and so it seems about fair. What's a strategy that's been very popular this year in terms of inflows is opportunistic credit, having a long playbook, and instead of a distressed manager, a private credit manager, how about a manager who can look for the best opportunities with a long playbook? So that strategy has been gaining a lot of traction. I think the positioning and credit in terms of getting alpha and dispersion that's not surprising with the results here.
You've been in the business for decades. You've seen a lot of cycles. You were talking earlier about the 70s.
Yep.
I hope that's not the analog. But is there an analog to the moment that we're in right now that you can think of in terms of investing, in terms of the macroeconomic backdrop?
So we're mid-cycle in a stretched environment where it's very narrow for what the opportunities are. That's like most markets I've been in. I mean, that's like just...
Doesn't feel like most markets for most people.
But
so,
if you were to go back and count,
yeah,
stretch valuations, very little dispersion except for a certain percentage of the market, call it less than 20% of the market. That's kind of most markets. I bet it's 3/4 of the market is what that is. It's certainly more than half.
So you think that the analog is almost every time except for the big extremes?
Well, I think that what's different this time, because every cycle has something that's different, and what's different this time is the AI expense and what the ramifications of who the winners and losers are. And you could have said that with media, with the internet, and who's going to be, when I think of software and try and conceptualize who the winners and losers are, I look at legacy media, and there was TV, which went from, call it nominal growth to less than nominal growth, but still growth. You look at cable programmers who still had above nominal growth for about 15 years. So those were healthy businesses. You had radio that, call it by 2008 or 9, seemed to really be a more marginal product, and then by the late teens, really in trouble. And then you had newspapers, which really peaked about, I'm trying to think of the Tribune transaction of 2006, 2007, and I think 2005, so after 2005, really began to be disintermediated. So where does some of these industries fall with that methodology?
Fascinating. And everyone wants to be not radio. Although radio is coming back with podcasts, so there's that.
Although it's not on the band, right? So when you're thinking about radio, as I grew up with it, it was AM, FM, and really FM for the most part. Though I think I remember being invested, the largest creditor in MS, which was WFAN on the AM band. But it was, but that's it's a different medium for radio.
Yeah, different distribution mechanism. Stephen Tannenbaum, always a clinic, always wonderful to speak with you. Stephen Tannenbaum of Golden Tree Asset Management.
Thank you.
That was awesome. You're so good. Here. Thank you so much. That was awesome. Always fascinating with Stephen. Coming up next, I want to welcome Trillions, financing the AI arms race. Anish Shah of Morgan Stanley, Maureen O'Connor of Wells Fargo, Robert Cohen of DoubleLine, Matt Brill of Invesco, moderated by Emily Graffeo of Bloomberg News. Please welcome the panel.
Well, the title of the panel is Trillions, and that's an ode to the fact that we all know the AI financing needs are just massive. Bloomberg Intelligence estimates CapEx for AI will approach $5 trillion over the next 5 years, and we know a lot of that will be debt funded. So that's what's happened. We want to talk about what's happening this year, that we want to look forward. There's been a lot of debt already raised, but Anish, let's just start big picture with you here. What's your expectation for the rest of the year for just how much AI data center related credit issuance we'll see?
Well, thanks. It's great to be with you. It's certainly fascinating times in the capital markets. Our estimate is that this year, AI CapEx and related funding could approach more than 10 to 15% of all the issuance across the credit markets. So, think about $400 to $500 billion of new financing, new capital being raised across the credit spectrum, whether it's investment grade, leveraged loans, high yield bonds, asset-backed securities. And just to put that in context, 2 years ago, this wasn't a sector that was being financed in the market. So it's quite a big undertaking. I think the good news is that early in this wave, we recognized a few things. Number one is that the project loan construction market that typically financed a lot of these big infra build-outs like LNG and midstream assets just wasn't going to be sufficient for the undertaking here. The magnitude, given bank regulatory reform over the last 20 years, there just wasn't enough capacity in that market. I think the second thing was that the hyperscalers were going to play the most critical role in the ecosystem. They have uniquely positioned balance sheets, high quality credit ratings, and just access to capital like no other companies in the world. And then the last is that we were going to be undertaking a new market structure, this is going to require a ton of product innovation. And so that's led to a series of transactions across new structured financings that really didn't exist before.
Maureen, weigh in here. You're in the investment grade debt world. What's your expectation for just where the growth is going to come from this year and what it's going to look like?
So maybe I'll take that in two parts. I think first, just looking at the hyperscalers, there's about $750 billion of projected CapEx amongst the big 5 hyperscalers in 2026, and that number is going to grow to north of $1 trillion next year and beyond. We anticipate something like 30 to 35% of that to be funded with unsecured on-balance sheet financing. So this is more of your like IT CapEx spend, whereas in data center finance, it does tend to be a little bit more asset level, and I can talk about the evolution of project bonds in our market as well. But just looking at hyperscaler debt issuance, that's something like 225 to 250 billion of anticipated funding this year. We've priced about 160 billion so far, so we assume something like 70 to 90 billion left to go this year. The US dollar market, obviously one of the deepest pools of capital and also one of the most cost-efficient pools of capital, will probably be the most important place where this takes place. But interestingly, this year we are seeing issuers lean much more into currency diversification than what we have seen historically from this group. So thinking about this year alone, about 30% of that $160 billion number has come in non-dollar. And just between Amazon and Alphabet, broken records in 5 different currencies this year. So increasingly, what were deemed as kind of more niche currencies are going to play a more critical role in this build-out. And I think it shows a willingness for these borrowers to expand their investor footprint, even if on an after-swap basis, the cost might be a little bit incrementally larger than what you can achieve domestically here in the US. But the US market, I think, is uniquely positioned to absorb this supply. Obviously, it's a very deep pool of capital. It's a $9 trillion market. But we have seen some underperformance in spreads, just given the supply overhang. But I think we're still a far way away from, kind of a saturation point in that regard, especially when you think about, the index weight of the big 6 US banks is still more than double what the hyperscalers are in terms of index composition. That number is going to continue to grow and shift. But there has been about 20 basis points of underperformance in the tech index relative to the broader index this year as a result of the supply overhang. But again, these are highly rated, low net debt companies, deep pockets for this type of paper. I think one of the more interesting evolutions, though, and Anish touched upon this, is we have seen more and more project level, so data center finance deals come into our market. About 4 of them so far this year, accounting for about 21 billion of supply. This number is going to continue to grow. So I think when we think about product innovation, we are seeing a merging of markets where project finance bonds were really something that was specific to the 4A2 private placement market, finding its way into the public bond channel, just given the size needs here. They're outgrowing some of these more traditional pools of capital.
Well, you mentioned the deep pools of capital. We actually have 2 people representing some of that capital here. Robert, let's start with you. How much capacity do you have as an investor to take on all of this debt?
Yeah, so we're a multi-sector credit firm investing across corporate and securitized markets. So generally pretty flexible, and we have a substantial amount of capacity. We have been, I guess, lighter. We don't own a lot of the hyperscaler debt because of low spreads and the risk of the widening that's happening now. They're not all the same. That's another point that I think needs to be made, that there's a credit curve across the hyperscalers because they represent different risks. But I think the market has a lot of potential capacity. Investment grade has a lot of capacity. People look at the size of the high yield market and they try to think about the percent that the high yield market can absorb. But I think the high yield market could actually grow if the right deals come. The high yield market has been shrinking really since the energy debacle, 10 years ago or so. There was a wave of defaults. And a lot of the risk transfer, a lot of the riskier deals moved to the bank loan and then private credit markets. So I think for the right deals, certainly you can tap the investment grade market, but I think you can actually grow the high yield market.
What is the right deal? What does that look like?
Well, I'm an old-fashioned guy. I think you're supposed to be financing stable earnings and cash flows, which is kind of maybe a curmudgeon way to think about things. The hyperscalers have excellent balance sheets, stable earnings. So for investment grade, financing those companies seem like that's a pretty straightforward exercise. In the high yield space, I use the same playbook we use for energy. So you need a very strong sponsor, whether it's a company that's drilling for oil or a company that's building out a data center. If that enterprise doesn't have its own credit wherewithal, its own credit strength or history, then you're relying on some sort of parent. In energy, it might be Exxon. In data centers, in the AI space, it might be Alphabet or Microsoft. So having that strong underlying sponsor is incredibly important. I think documents and structure are very important. The combination of the two, and of course pricing, but the combination of a strong underlying credit support and strong documents, I think, are critical to make things work.
Matt, let's bring you in. What's attractive to you right now?
So one of the questions we get asked a lot is, when we buy debt of these hyperscalers or these SPV type projects, what happens if AI fails? So the way that we think about it, because we don't get the upside on the debt side that the equity market does, right? So from our seat, what we're trying to do is, if this doesn't go anywhere, if this is, I don't want to say a bust, but if it doesn't really go on to completely change the world, are the bonds that we're buying still money good? And so the biggest thing for us in a lot of the structures we're looking at right now is similar to what Robert said, is having this anchor tenant, if you will, the anchor parent that is kind of backing these and typically leased on these deals. But really, it's the amortization of chips, and it's getting your money off the table as fast as possible. Because we know technology is changing quite quickly, and if we're lending to technology, we want to protect ourselves. So a lot of the deals that we've been trying to be leads on in structure are really trying to take a 50% loan to value and have it go to zero over the course of the bonds. So there's no roll risk at the end. There's no value of chips that we have to be worried about, because we know the chips are probably going to be worth less. Maybe not. But if we're going to assume the worst, and if that's the case and we still make money off of it, we think we protected ourselves pretty well.
Anish, how do you think about that, this idea that we don't really know how artificial intelligence is going to play out over the next few years, and yet we do need all of this capital to fund the build out of it?
Yeah, it is what we're tackling every day, is trying to think about how do we get a product that satisfies the needs of the issuers and delivers capital with speed, because the pace of development is so fast, but also hits on all the key points that the investors are really focused on, and which are liquidity, relative value, and structure. Like those three things matter a ton in what we do. And so if you think about some of the product innovation, the first, from my lens, was the Meta partnership with Blue Owl, which was really transformative. $30 billion data center project, $27 billion, the largest project bond that's ever been issued. And then being able to work with a single investor who could anchor such a substantial majority of it. The focus on covenant and structure and residual value guarantees and things like that was really intense. And the rating agencies as well have been very deep in all these structures. The second I would highlight is something like the CoreWeave Term Loan B, which was recently syndicated, $3 billion, the first time that a GPU financing was syndicated into the institutional loan market. But it wasn't a vanilla financing. It requires a lot of structure. There's amortization, there's asset level security, there's corporate level credit protections. And the last, and I think probably the most noteworthy innovation, has been the data center construction financing that our team has executed in the high yield space. Starting with TeraWulf, more recently with Meridian, there's been almost $30 billion of high yield issued to finance data center build-outs. But I can tell you they're not vanilla by any means.
I think this is a good time to bring up the audience question. So we'll pull that up. Well, oh, that looks like we've already voted on it. Here we go, the polling question. So if you want to take your phones out, if you haven't already, you can scan that QR code. The question is, what's the best way to invest in the AI boom, hyperscaler bonds, AI infrastructure, like specifically data center debt, equity, avoid the debt, or pass, it's all too rich? We got a little preview of the early results, but we'll let a couple more answers come in and come back to this later. Robert, I do want to get kind of your take here, just how you evaluate all of the different AI-related deals that are coming through. Is there one area that's most attractive? Is it we only want to do GPU deals? We just prefer the power, the utilities? How do you think about that?
Well, I think we have to take a step back and say, what is the probability that we're in an AI bubble? And I guess we'll define bubble really quickly. Credit bubble would be credits that are unable to pay back the debt, and it seems pretty obvious at issuance. So we saw that in energy, where there were bonds that just you knew they couldn't pay them back, and they defaulted right away. So credit instruments that require a lot of growth, I wouldn't call a bubble, but I think that credit that basically is doomed is a sign of a bubble. We're not there yet. The equity markets kind of worry me. So the definition of a bubble in my mind for equity bubble would be valuations, growth expectations that are impossible to meet. I think for some of that, we're starting to get there. So if you think about the backdrop of what's the probability that we will be in an AI bubble, maybe I'll put 100% on that because we have 200 years of industrial production that has led to bubbles whenever there's a huge technology development, whether it's railroads, we've heard all the stories, railroads, telephone, internet, and then now AI. I think you have to think about what credit will survive a deep cycle. So I think the hyperscalers broadly, well, I shouldn't say broadly, some of the hyperscalers will do well. I worry about Oracle. So Oracle looks like it kind of has a high yield sort of profile. The spreads look like high yield. So you want credits that either through structure or just a very strong balance sheet will survive through a cycle. That's the lens. So I don't want to take a lot of technology obsolescence risk. So I was an analyst when the dot-com bubble burst, so maybe that's coloring my view. But I can check a lot of the boxes for things we saw there. But I think you really need a strong balance sheet more than that, more than anything else. I think the speculative credits that we really haven't seen yet, but I'm pretty sure are coming, are the things to watch out for. The credits that need a lot of growth in order to service debt, that's what you need to worry about. So if you're looking at a credit and the cash flows and structure you see now are sufficient to pay off that, or to service that debt load, then I think that's something that's going to survive a cycle. But the ones that need dramatic growth, that's what I'm worried about. So I'll leave it there.
Matt, what do you think of this idea of an AI bubble?
So I mean, I always like to say we don't need to shoot the lights out. We just need to keep the lights on. So as credit investors, we just need these companies to keep going. But I go to these meetings and we'll do 30 minutes in a meeting and it'll be like, how are we going to use more AI? What are we going to do with more AI? AI. And then the next 30 minutes is there a bubble in AI? And I about lose my mind. I'm like, we just talked about doing more and all the investments that we're going to make, yet we think we're in a bubble today. Like I do think, Robert's potentially right that at some point there could be a bubble here. I don't think it's inevitable, but I do think we're not in one right now. And I think the earnings are proving to play out as in the current environment. Again, we don't get that upside, so we have to be very careful as credit investors that we protect ourselves. But overall, I'm a little more positive on, or a lot more positive on the overall view of AI and overall in just the equity markets, but also in the credit markets as well.
We've talked a little bit, about this, about in-anchor tenant, but Maureen, I am curious, what else you're offering to the clients that come in when they ask for kind of downside protection or any structural enhancements in these AI-related deals.
So maybe speaking specifically about data center finance, I mean, I think the focus on structure, to Anisha's earlier point, I think is going to be paramount here. So maybe putting aside on-balance sheet financing, these are obviously high-quality investments, and I think default risk there is very low. But when you look at, the project deals coming through the IG channel, a big focus on structures that fully amortize through the initial lease term. A big focus on reducing any refinancing or releasing risk on the other side. Because again, when you think about the evolution of GPU technology, these leases are 20 years long. Like, we don't know what this is going to look like in 20 years. Are we going to need hundreds of thousands of square feet of data center capacity in rural America to generate the same amount of compute? Think about your cell phone and where we were 50 years ago with the computer, right? So I think there's a lot of concern that in 20 years, there might not be, a releasing market that looks quite as robust as maybe we think it does now. So I think that's going to be a key point to investors. But then the balance of that, of course, is that these are developer and sponsor-led structures as well, and they're looking to maximize the returns on their investments as much as possible. So there is a push and pull. So I think the kind of merging of the private and public markets has been such that there is a lot more negotiation happening in the front end of these transactions rather than the traditional investment grade channel, which is just to put transactions on the screen. So there's a lot going on behind the scenes. Anish mentioned the Beignet transaction, obviously took over a year to put that together. I think that the lead time is getting smaller and smaller, but there is quite a bit of negotiation back and forth on structure to balance those two counterparties.
So we'll have more Beignet style deals this year. We already have one in the works right now with Blackstone and Apollo and Anthropic.
Yes, on the GPU side, but there's a huge pipeline of the stuff coming, yes.
Back to the buy side, I do want to get a sense of how much capacity you have for, if you're hitting any limits in terms of like single names or specific sectors. If we look at just a couple of the hyperscalers this year, like they've already issued over $100 billion in debt. I wonder if you hit a point where you don't want any more exposure for the rest of the year to one specific hyperscaler and need to kind of pivot somehow.
I can only speak for our firm. we, in a tight spread environment, we tend to be more cautious and keep our allocations lower than we normally would. So that provides us a lot of dry powder. So our firm has substantial capacity to add to the investment grade, if we're talking about investment grade asset class, but also individual names. So I don't know that that's universal. When I hear from investors, everyone says that they're being cautious. So if that's the case, then that means that there's still capacity left. I also think that it matters for spreads. So at the right spread, I can easily be bribed to go into some of these higher quality credits because you basically haven't been able to get any yield out of Microsoft, Amazon, Google, now called Alphabet. I'll never be able to switch to Alphabet from Google. But to get those kind of high quality credits with some spread, certainly I can be bribed to do that. Now, what's the capacity for single B? Not that there have been a lot, but very risky growth types of financings. I think there the capacity is more limited.
So I think there's two constraints that we're looking at. First is just exposure to technology directly. Obviously, what are the limits on that? We have participated in a lot of deals that Anish mentioned earlier, and actually everybody thinks about hyperscaler debt has done poorly this year, but the ones that he's mentioning have done fantastic. The SIFR and the Wolfs and the Beignets are all up 5 to 8 points. So if it's structured right, it can do really well. Now we do have to take in part point 2, which is the liquidity and making sure that we're able to move some of these. We're in them for a while. They've played out very nicely. Do we want to hold them for the full term, or do we want to be working out of them? So number 2 is really that 4A2. There's a name that, or an asset that we never really thought about in the past. How much exposure do we want to have to that? Do we limit ourselves? Legally there's limits on it in mutual funds and ETFs, but then there's risk management limits. How much do you want to have? Is it 2.5%? Is it 5%? Is it 10%? What's the right number? And if they are more liquid and you can actually trade them and they're 4A2, then I think the answer is larger. If they are completely untradeable, the answer is probably lower. And then the also part, is amortization. If you get amortization, you're getting money back. You're de-levering yourself or de-exposing yourself to this sector little by little over time.
The 4A2 market is interesting because issuance in that market every year is only about 100 billion, 150 billion. Are we going to see more companies tapping the 4A2 market directly? Maybe a niche.
Yeah, I definitely think because the buyer base has grown, right, with the advent of all the capital that's flowing into insurance, so we're going to see more there. But I will tell you, for the scale of this, most of our issuers are looking at 144A or registered markets because that's where you get the deepest, most liquid pools of capital at the best, most efficient pricing.
Okay, so, sorry, go ahead.
Say is if Anish wants to make more below investment grade names at a high 7% coupon at a discount amortizing, those are pretty good. Yeah. Now they've all traded down to 6%. So I think Wolf was priced at 7 3/4. It's now trading at 6%. You want to issue something like that again at 7 3/4, then I don't know. Maybe can I give you an order right now?
Yeah. Get a pen out. Okay, we only have a couple minutes left, so I do want to get to the audience poll responses. What's the best way to invest in the AI boom? Okay, this is interesting. 34% said equity, avoid the debt. And this is a room of credit folks, I presume. 17% pass, it's all too rich. Only 4% hyperscaler bonds. And the top answer, AI infrastructure, data center debt at 45%. Maureen?
Well, I think this is interesting, right? If you're looking, if you are comfortable with the tenants, and generally speaking, the tenants are, the mega cap hyperscalers, and their bonds are rich, we can all agree, hyperscaler spreads, maybe putting Oracle aside, are trading well through the index. How do you pick up incremental yield with the risk you already know? You do that through these 144A structures. Again, with a focus on structure to make sure you know what you own, but the basis to the hyperscaler in a lot of these situations can be north of 100 basis points, right? So you have some incremental yield pickup there. So it's interesting. Now, obviously, the give is the liquidity dynamic, although I would argue that has evolved quite quickly, especially as we've moved more off of the 4A2 channel into the 144A market. But it's not surprising. It's not surprising. These deals are interesting, and this is why it will become a growing part of this whole landscape.
Robert, you want to weigh in on the results?
You look at it, so I don't know, over 80% is saying they won't, the room is constructive on investing. It's just a question of where in the capital structure you want to do it. I think, my interpretation of that is you either want to be at the top of the capital structure or where it's safe, or you want to invest in the equity where you have the upside. And being in the middle maybe is not the best place to be. So that's how I interpret that. And I think that makes sense. I think you want to, if you're going to be a debt investor, you want the return of capital or return of principal, and not return on it. And if you really want to invest in some of the growth that I'm worried about, but then you do that in the equity markets.
I just think, I thought Marie made a good point earlier about the length of time it's taking for some of these deals, because it's shortened, but it still is kind of a bond picker's market. And I think that we're all active managers here, and what we're trying to do is create value and add value for our clients. So the top makes the most sense to me, because that's where we're going to be able to do that, right? At the end of the day, the vanilla is at the bottom. The vanilla is you kind of get what you get. The deal is, it's already been spoken for. It's $15 billion of unsecured deal. It's not very exciting. The top is pretty exciting. It was actually fun to be involved in this environment right now.
The pass, it's all too rich is maybe also interesting as well. I mean, Anish, what do you do when someone comes into your office and says, I'm just going to completely pass on all of this stuff that you're trying to sell me?
Yeah, look, I mean, I think, I honestly think from my lens, supply is like the biggest risk in the markets, is because there's so much that needs to be placed. I do think collectively we've been very thoughtful, and our clients have been really thoughtful about diversification, currencies. Maureen talked about it. I mean, I think we're issuing in every major currency now. I think we're going to see that in the high yield market. We're going to see that in the loan market. And so I think issuers are really trying to get ahead of this, because they know that there is a potential that there could be some pushback. But for now, it's been all green lights.
I'd like to finish on the macro. We have just maybe a minute left here. But Matt, I am curious about your thoughts on whether we see more spread widening more broadly this year, because overall IG spreads are still near historical levels of tightness. I'm wondering if all of this supply changes that.
So I'm not worried about the supply as long as rates stay elevated. To me, the only way, and I always say this, and it's probably going to be wrong, but the only way that we go wider in spreads is if all-in yields go materially lower. There's just so much more demand, and the supply is a lot, yes, but the demand's even greater.
Robert?
I generally agree with that. I mean, we could have some modest spread widening, but there's too much capital flowing in terms of this capital spending or in a strong economic environment. I think for spreads to widen, it would be not just from supply. You need something more substantial on the geopolitical front, which I think we have enough of that right now. So spreads have absorbed all of that. So I'm going to basically agree that I don't think spreads do anything material this year.
Yeah, I mean, rates are high, spreads are tight, and we've become kind of a macro product in investment grade in that regard. I do agree that I think the only thing that shakes us meaningfully loose from this very tight range is probably a meaningful turn in the economic data and a rally in treasury yields. That said, I do think we are fully valued here. I'm not sure I see a meaningful grind tighter as well. I mean, painfully, the investment grade index has traded in a 1 basis point range for the last 2.5 weeks. I mean, it's a tough market to trade in, but unfortunately, I think it's going to be a range-bound market going forward.
All right, well, that is all the time we have. Thank you guys so much.
Thank you.
A wonderful job as we all try to wrap our heads around what is coming with respect to artificial intelligence. I want to welcome to the stage two people who are wonderful in their field. Scott Goodwin, a star of the credit world, Diameter Capital Partners, in conversation with Danny Berger. Please welcome them to the stage.
Thank you, everyone, very much for joining us. And Scott, thank you very much for sitting down.
Thanks for having me, Danny.
And it's funny, when we were talking about this, we said, okay, we'll start on where we are in this moment in private credit. And the news gods have gifted us. Yet again, redemption requests, gating is back in the news. Is this just a sign to you that not only are the jitters not over, but they're here to stay?
I don't think it should surprise anyone. The prisoner's dilemma of, if I don't redeem and everyone else redeems and I get left with the bad stuff, sorry, I'm just losing the mic here a little bit. But if I get left with the bad stuff, is a difficult thing. So you're almost forced to redeem if you're in those retail funds, because you don't want to get left with the bad stuff at the end.
Citi had this interesting report out, and they basically said, what if this time around the retail money is the smart money? It's usually flipped, right? Retail follows what some of the institutional capital does. Do you think there's a scenario where that is the reality that's taking place, that maybe this starts as a wealth and retail scurry away from some of these private credit vehicles and morphs into something bigger?
You've seen where the public BDCs trade. They trade as a percentage of gross asset value between 0.85 and 0.95, which is like 0.7 to 0.8 of NAV. So the public markets are telling you there's a problem. I think the dispersion you're going to start to see across the lev fin direct lending or private credit space is going to tell you that not all people were bad actors. Some people were prudent stewards of capital, and not all the loans are bad. In fact, most of the loans are probably fine. But there are a lot of loans that are exposed to AI risk, not just in software, but other sectors as well. And we don't think, and we talked about this at Stone a couple weeks ago, we don't think that's a systemic problem. It's only a $1.5 trillion market, of which $300 billion is SaaS, or a little bit more, $500 billion is SaaS. But if you have defaults over time in that market, it's going to take time for those things to default. 28, 29, 30, 31 are the maturities. The recoveries are where I think the market's getting it wrong. A lot of people who've been in private credit for a long time say, oh, senior secured loan, the recovery will be 60, 70, 80 cents. If you look at BSLs and tech loans the past 5 or 6 years, what have the recoveries been? 10, 20, 30 cents. You're going to end up with very low recoveries. If you have a 2031 maturity and you're a sponsor and you think your business is really under threat of AI, you have two choices. Either take all the cash flow and invest in becoming an agentic company, or take dividends. Both have their benefits and positives and negatives. If you choose the latter, you're essentially turning the loan into an IO.
Right. By the way, I think this is probably a good point to bring up the poll that we have, speaking of defaults. I know you're talking about recoveries. We have a poll, if you all want to get out your phone and scan the QR code. By year-end 2027, what will the 12-month default rate be among leveraged loan borrowers in the software sector? And I do want to say, Scott gets to define the terms of this question as to what a default rate is. What are we saying? Hard defaults?
So we're going to say hard default plus LME it counts as a default, because if it was just hard defaults, I think everyone would pick one.
Yes.
Because this is a slow-moving train wreck. But we're going to say hard default plus LME for this question.
Okay. Well, everyone get out your phone, do some votes. We're going to revisit what exactly the answers are in a little bit, and I'll have you comment on it and see what you think. So in this moment where there is this big disruption in just kind of a pocket of the market, I just wonder, has there been a coming to terms yet? Are marks honest yet? Has this industry really grappled with, I don't know, what software looks like in those lower recovery rates?
So are the marks right? I think the answer is still no. When we were looking last summer at the public BDCs, we found mark discrepancies as great as 40 or 50 points in the same loan from one BDC to the next. We found one guy who had it marked at 60 and another had the same loan marked at par. So we shorted the one that was marked at par, and then eventually they had to mark it at 60 and it went down. But you know, the data that we have on BDCs shows that the average mark difference for the same loan has gone from about 1% pre-COVID to about 6% now. So you're seeing this mark dispersion increase. I think the regulators are going to start focusing on this, and marks will come more back in line. Obviously, Mark Rowan and Apollo have been talking about daily marking. We're all in favor of transparency and marking. We're public markets people at the beginning who also do private credit, so we like to deal in that mark-to-market world.
All right, well, let's see if we have some results from this poll. I think maybe we've had it for long enough. All right, 5 to 10%. Can I get your thoughts on that? We kind of landed squarely in the middle, if that's...
Yeah, I think the software default rate, you're betting that there are going to be a lot of LMEs then by the end of 2027.
Right.
I'd be either in less than 5 or 5 to 10. This is a long-term problem. You know, AI might make some of these companies better in the beginning, and then it's going to kill them.
Right.
You know, the number of LMEs that are going to happen in software is going to accelerate. But it's going to, if you think about the maturities, you have to look 2 years before the maturities, start thinking about when that LME happens. And the maturities start happening in 2028, 29, 30, probably clustered in 29 and 30 on average. So we'll see. I think the audience probably has it right with that 5 to 10.
By the way, this is often framed as uniquely a credit problem. And people who are in credit markets love to say, look, if it's a problem for credit, then the equity should be trading off. Obviously, it's happening in public markets. I just wonder, is that the right framing? Is this, you know, a uniquely equity problem, or is there something about the structure of credit that we should be more concerned about software exposure?
Sure. Well, again, it's a high teens percentage of the syndicated loan market, a very small percentage of the high yield market, and a third of the private credit market, depending on how you calculate it. And it's not just software; it's other AI exposed things. Right. The issue becomes this isn't oil wells or widget makers where there's hard assets there when you have a default that you can take. If a software company goes bad, the recoveries have historically been very low in the public markets. And that's what makes it a lot different. I think people who say, oh, it's the equities problem, are wrong. There's been a lot of people in the direct lending space who said, oh, it's the equities problem, I'm going to be fine. Look at all the lending we've been doing to SaaS forever. If the equity has a problem, the credit's going to have a problem too. We learned that lesson the hard way in an investment we made about 7 or 8 years ago in the software space that went bad. We thought we were going to be okay. We weren't. So I would say that there's going to be a problem on both sides there. And then if you're thinking about investing in software, wouldn't you rather buy the large public software companies in the equity market that have derated materially than buy a smaller levered one that doesn't have the same financial flexibility to change its business model?
By the way, is this part of the market just frozen right now? There have been stories, for example, of Thoma Bravo going out to market, kind of struggling with lenders for various of its businesses. Are software deals still getting done? Have you touched any of them? I mean, what does it look like right now?
So in the first leg of a sell-off, it's always high correlation. So in the first leg of the sell-off in SaaS, and we started talking about the risk to SaaS in 2023 in our letters from AI. In the first leg of the sell-off this year, very high correlation. Some higher quality loans went down too much. So we bought some of them, 3 or 4 of them. They traded back up. It's a trade, it's not an investment. It went from par to 85, they're back to 95, we're exiting. Do I think it's time to do distressed SaaS or to be really aggressively bidding for private credit SaaS? No. Way too early in the cycle. And if you're already distressed, you're already struggling, and AI hasn't even really had that big of an impact yet, that's not what you want to buy. You want to wait for the good stuff that starts to trade down. And we're starting to see that selling from the BDCs as they get the redemptions. We've bought some things, not SaaS actually. We've bought some things from in the secondary market from BDCs that needed to sell in the private credit space. I do think over time there's going to be pressure from the banks who provide the leverage to these vehicles to reduce the SaaS exposure. We're already seeing it being capped by some of the banks. Hey, you can't have more than 25%. You can't have more than 20%. That's going to force some de-risking. What are those people going to sell? They're not going to sell the loan at 50 because it doesn't do anything for them in terms of delevering their vehicle or changing their ratios. They're going to sell their highest quality software loans at some discount to par. We'll be interested in those.
By the way, just speaking of concentrations, where the deals are getting done, and you're even seeing on the banks starting to acknowledge some of the concentration risks in terms of hedging, is anything having to do with data and data centers rather, and AI. I just wonder, we came from this period where, I mean, you've been very forward about this. Private credit made a problem. They were overexposed to software. Are we starting to head down the road of making the same mistake again with just this immense appetite for AI data centers and related deals?
Yeah, I think it's early. It's a low single digit percentage of the high yield market, a growing percentage of the investment grade market. But these hyperscalers have a lot of cash flow. They're big companies. You're not dealing with very small companies. We'll see which LLM ends up winning or which LLMs end up winning. But right now, you're seeing a lot of data center financing in the CRE market, in the high yield market, in the investment grade market, in the private credit market. Now in the levered loan market, there's chip financing for CoreWeave that just happened. They're tapping every market. We're not at the saturation point yet where it tips over. It's like a bathtub that's filling up. And drip, 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 drip.
But everybody is gobbling it up because there's so much capital chasing these things. Is there real differentiation happening in the market yet?
People aren't doing their work on the docs, especially on the public high yield bonds that are coming. They're not saying, oh, this one has more construction finance risk than this one. This one has more a different hyperscaler risk than this one. They were 6 or 9 months ago. Now that the high yield market trades so tight, and most of these credits are well rated, they're rated BB because they have a hyperscaler contract, and they're yielding, say, 7.5% or 8% versus a BB market that yields a lot less than that. Oh, I can get excess spread or yield for the rating. I'm just going to buy that. And there's a race to buy it right now that's different than you saw kind of 6 months ago. It's interesting to see the herd really start to chase it.
And this is just because spreads are tight that's causing this.
It's the best excess spread opportunity in the market that's not distressed. You have multiple sectors in the market. Software obviously has its own issues. packaging because of GLP-1s, and the 20-somethings not drinking alcohol is struggling. And then housing's been in recession for years. So multiple sectors in the credit markets are struggling, and this is a space where it's going to be liquid, new issue paper that's tradable, that's coming with excess spread. But again, there's so much of it.
Right.
You have to pick and choose which ones are investments and which ones are trades.
But if that's not happening, does part of this end in tears? What does it look like for the people who haven't done their homework?
Right now, and I think I saw Steve speaking earlier, he said, people tend to look 2 or 3 years in the future. 2 or 3 years in the future, there's still going to be a lot, as far as the work we've done, a lot of compute demand and a lot of power demand. So let's say some hyperscaler doesn't need that data center, doesn't need those chips. It's likely in the next 12 months or 18 months, someone else will step in.
Right.
Where can that be wrong? If there's a regulatory intervention in terms of the rollout of AI. You're already seeing, you saw Sam Altman this week say, oh, we're not going to kill jobs, we're going to create jobs. They don't like the 15% approval rating, so they're changing their tune pretty fast. And I think that part of it is something that we'll have to watch, because the regulatory risk is real and can be acute.
So does this play out, for example, we've seen it in places like Northern Virginia about the populists pushing back against data centers. So is that the risk of the sort of NIMBYism that goes on, saying you can't build here?
It's a real risk. It's a real risk.
So politics is one of the risks. I'd also be curious what it does to the overall market structure, because we've had this basically supply-demand dynamic of capital being so plentiful, and it's been the bullish thesis, right? Yep. Spreads are really tight because money needs to get put to work. What happens when we have, estimated $7 trillion worth of spending by just the hyperscalers by 2030? Does that dynamic start to change?
Yeah, you have a huge problem. I think the tipping point will come kind of by mid-2028. You're going to be in a situation where hyperscaler debt issuance and spending is crowding out government debt issuance, other investment-grade debt issuance. You're going to be at a saturation point in the private credit market, in the high-yield market, where you start to tip the scales a little bit the other way. It's interesting that Google came this week with $80 billion of equity.
And then up to 85.
And up to 85. And we'll see if it's interesting to me if that's equity that's in lieu of doing bonds, or equity that then you can then take and put in an SPV and lever 5 times to create $400 billion of new stuff. So we'll see what Google does with that. But the CapEx numbers are huge, and we have to be cognizant over the next few years of when that tips over. I do think it's like that bathtub filling up, and eventually there'll be too much. But right now, things are okay.
Is the issue then for things that aren't data centers, basically, that spreads widen everywhere else in the industry except for this one part?
Think about other large issuers of debt. If you're in the cable industry, you're struggling, right? You're under attack from fiber to the home, from fixed wireless, maybe from SpaceX. You're struggling, and you're a large debt issuer. Would someone rather buy bonds in Google or Microsoft or Amazon, or one of those large cable issuers, right? They'd probably rather buy the first group. So it's going to create this crowding out effect on companies, especially companies that are struggling. And there's going to be a lot of winners and losers. AI is going to create tons of winners and losers. I mean, the technology change at the turn of the century, when I was starting my career with what happened with the internet and then with fracking, 10, 15 years ago, create a lot of winners and losers. This is going to be much bigger than either of those cycles.
Where do you think the greatest default risk is going to lay as we go through this cycle?
SaaS is obvious.
Right.
There are other sectors like healthcare IT, business services, private equities piled into various insurance brokers type strategies. I don't know. It's hard to know yet what the full impact is. And we're not in it's going to kill tons of jobs or it's going to create tons of jobs. I say we're somewhere more in the middle. We're net hiring because of AI. But if you have a situation where it does go more towards the job destruction tail in destroying white collar jobs, that's going to be a U.S. economy and GDP problem. And then you have a real macro cycle.
By the way, how have your hiring plans changed since you started to incorporate more AI? I'm assuming you're not getting rid of. I'm assuming you never had any low value human capital, shall we say?
We value everyone at Diameter equally, and we've started hiring people out of college. We never hired college grads before. We always used to let them do a training program somewhere else because that was a tax on us to train them. But now the AI nativity of the college grads is so powerful that we've hired a number of them this year, and I think that number is only going to grow relative to somebody who's been in the business 10, 15, 20 years, who have the knowledge of credit, but they haven't grown up in AI. So their ability to come in and help implement, especially if they're interested in finance and computer science at the same time, has been a really interesting and novel thing for us. In terms of
A
hiring.
lot of your private capital peers have taken the route of, we do a partnership with X LLM, they give us forward deployment engineers, and that's how we kind of implement it. What do you think of that model? Does that make sense to you?
Yeah, absolutely. We're using all three of the large LLMs, and we want to protect our data. So we like having people on site and on our own team that can help us implement and think about it.
How do you think about the macro economy as a whole? Is this something that sees a great kind of job displacement, or do you think more things go the way of what Diameter is doing, that actually there's a greater demand because there's demand for people who understand this stuff?
So first, it's a positive. You have to hire people to help you implement, or somebody's sending you a forward deployed engineer. And then the question is 2 to 3 years out, what does that look like? I don't think we know yet. Certain industries, the business process outsourcing space, call centers are obvious. There's an obvious threat there.
Right.
SaaS. How many seats do you really use the same SaaS company? Okay. There are obvious things, but then beyond that, I think it's TBD.
So we only have a couple minutes left. Got to talk about the shoes. I know you all probably can't see it, but Scott is wearing the coolest shoes. They're U.S. men's soccer team shoes. You're on the board. And you also helped hire Pochettino, which thank you for that, because the biggest mistake Chelsea ever did was letting him go. They look great again. How are you feeling? I know you're going to be going to a lot of games. How's the team looking?
They look really good. You like Poch. I like Poch. We've got a coach who believes in grit. He believes in heart. He's instilled a culture with this team that is extremely strong in terms of the cohesiveness of the team, working as one unit, not individuals. And that's something that, in a sport where I don't think anybody who's a soccer fan or a football fan would say the U.S. doesn't have the same talent level as a France or Brazil.
Right.
But heart and home field advantage can make up for those talent deficits.
How big is that this year? Because, these teams are traveling so far for all of their matches.
Yep.
That's got to be taxing. I don't know is that an advantage for the U.S. men's team?
We strategically have our first 3 games in domes or mild weather stadiums so that we don't get as burned out in the first round of the tournament.
Are you allowed to dictate that about?
Well, the U.S. as the host was kind of able to figure out where they were going to play the first 3 games. So the LA, Seattle, LA are the first 3 games.
Wow, everyone's all of a sudden going to get Poly Market out on their phone, being like, all right, which teams?
The U.S. was trading at 80-1 actually before the World Cup draw, so that was an interesting buy on the prediction market.
Do you have any predictions? I don't know if you're allowed to say anyone makes it to the finals besides the U.S., but.
I think we have to take it game by game, but let's go USA.
What a perfect note to end on. Everyone, please join me in thanking Scott Goodwin of Diameter.
Thank you so much. Really
Fantastic. It's full circle because we started with a poll, who's going to win, and USA actually was outnumbering some of the others, and here we were. I'd like to welcome our next panel of Bloomberg intelligence specialists. I'd like to welcome to the stage Robert Schiffman, Jody Lurie, Noel Hebert, and Paula Seglison of Bloomberg News. Please welcome them to the stage.
Welcome everyone to the last panel of the day. We are standing between you and lunch. We're almost there. But this is an exciting panel because we're going to think about 2026 and beyond and really try to end this looking forward into the future. So to get started, I wanted to ask actually about spreads. So investment grade bonds and high yield bonds are at historically low spreads. And the question is, are they potentially going to widen in this year? And more importantly, if they don't, are investors mispricing risk?
So potentially widen, sure, why not? I think realistically, I think we'll maybe break it into the component parts. From the investment grade standpoint, I think we entered this morning about 72 basis points, which is basically 1 basis point from multi-decade tights, right? But I think on investment grade, really, it's the LDI or the duration liability manager investor that's really kind of keeping that market afloat. And so if you look at aggregate yield, just because of where rates are, right, and we're north of 5% in terms of yield to worst, there's room for certainly investment grade to stay tight so long as rates stay high. If rates come down for some reason, if we get some sort of recessionary dynamic, then you could see spreads widen on that basis. But where we are now, I think it's more of a rates-driven market. High yield's a totally different animal. Right now, I think we're kind of call it 260-ish, somewhere in that neighborhood in terms of spread. If you exclude the worst 5% in terms of the widest yielders, you're actually inside of 200 basis points. That is historically tight, more so than investment grade. That's a market that's really dependent upon continued low volatility, continued momentum in equities. So I think there is room for high yield to underperform on that basis, just because so much of the market is consolidated at kind of 200 basis points and tighter. But again, it's kind of a macro climate dynamic.
Mm-hmm. And Rob, can you speak a bit about the hyperscaler impact on just where risk is right now?
Sure. I hate to sound a little bit wishy-washy, but I've never been more bullish on the tech space. There is no AI bubble, and there's not going to be an AI bubble. And if we're thinking about whether or not this crowd is willing to buy more bonds, well, the ones who are selling the bonds are the Mount Rushmore of credit. Alphabet, Microsoft, Amazon, Meta. I'm not worried whatsoever. And quite frankly, very few people are. I actually want you guys to revote on what asset classes you want to be invested in, because you're lying. Of course you want to be invested in the hyperscalers. You're only 4%. You know, hundreds of billions of bonds have been bought at enormous oversubscribed levels all across the globe in multi-currencies. There's really not much to be fearful of. And quite frankly, I think like when we talk about the baseball analogy that like we're just in the bottom of the third inning, we're not even close to that. We're warming up right now. The amount of growth that you're going to see in the AI space over the next handful of years is going to be, I think, well beyond what consensus is. You're starting to see flavors of that right now. The equity markets are reacting to that, and bondholders are waving in bonds. I think you're going to see that theme continued.
And so much.
I was going to say, for those of you who've heard Rob speak before, I mean, that might be a record time to get to the Mount Rushmore statement. So tick off your bingo cards for that one. We've got that one settled, but go ahead, sorry.
Lots of excitement here, obviously, about the AI infrastructure build out. And so when we think about risks in the coming years, so much of that has to do with the health of the consumer, especially for a lot of leveraged finance borrowers. So far, so good, but there's a lot of question marks of what the future holds. So Jody, would love your take on that.
So I think the key here is that the consumer continues to be resilient. And we hear that over and over. And every time we run our travel survey, we are shocked to see how people are still planning on traveling. Now, how they're borrowing to travel is key, because 64% of those that we just surveyed said that they're either using credit cards or buy now, pay laters. So that's a substantial amount of people who are using that to go on vacation, which is not, your everyday expense. When you think about the fact that leisure, right after the pandemic, everybody was spending, everybody had extra cash, people were getting rebates checks from the government so that they were taking it and then going to the casino. That isn't what's happening here. And so we are seeing a bit of a bifurcation right now between the lower income and the higher income consumers. And we actually just did a note looking at our travel survey, segmenting it out. And if you look at the lowest income people who plan on prioritizing vacation this year, those who are planning on increasing spending, it actually went down from what we did in November, and those are at the highest echelon are planning to spend more and have actually already increased their budgets. So that's just an indication of the fact that we are seeing a bit of two different stories going on. That K-shape is very much alive right now.
Mm-hmm. And then, of course, one of the biggest open questions right now is interest rate policy. So for our last poll of the day, Goldman Sachs says we're going to have cuts, but what do you all think? So please go ahead and vote. Will the next movement be a cut or a hike? And we'll get back to that answer in a few minutes.
Where's number 3 for neutral?
The next time something changes. And so I wanted to ask you all, though. So there are a lot of borrowers who really banked on interest rates going down. Mm-hmm. And there's a lot of very over-levered capital structures, especially from the 2020-2021 timeframe. And if there ends up being a hike, what does this mean for those borrowers and for credit markets overall?
Oof. All right, well, I guess it depends on the borrower, right? I mean, I think hikes in and of themselves for most borrowers probably don't mean a heck of a lot, right? Unless you've got debt coming due. But it's also, I think, really important when you start talking about interest rate policy, we're only talking about a very small part of the curve, right? So the reaction function of what the rest of the curve does is much more important in terms of versus what the Fed does. So if they're hiking because there's inflation policy or inflation in the market and people are anticipating longer term inflation, so the longer end of the curve is up, that certainly is going to impact sort of borrower behavior and sort of how that flows through the market. But the hiking of itself, I don't think is particularly meaningful in terms of how borrowers react, with the exception of, obviously, on the floating rate side, when we're talking leveraged loans or private markets, and I'm sure that's been a big topic here today as well, that's the component of the market where you really have to think about their response function. And there, I think, leveraged loans, by and large, have largely extended, so you're not really super exposed at this point. New, weaker borrowers have mostly moved into the private credit market. That would be the space where I'd probably watch for, a little bit of squishiness. Unfortunately, we're seeing some of that right now. And again, we've heard people talk about some of the SaaSpocalypse stuff, which I know Rob is big on as well. That's a space where we could start to see some problems. But again, it really just depends in terms of the sponsor-led deals, who's going to cut checks and that sort of thing. So you can navigate, but I think that's the part of the market where I'd be looking to if monetary policy is going to get more restrictive.
And I think just to build on that, if you look in my sector, for example, which is all the companies that borrowed during COVID just to stay afloat because they weren't allowed to operate, so many of them are in such a better spot now because they've refinanced, they've pushed out their maturities. And so when you look at it, you don't have that quote unquote maturity wall right now that we're seeing that we saw maybe a few years ago. And so knowing that, it gives them a little bit more breathing room. Now, I think the key though is that so many of the companies have done a good job in terms of refinancing, pushing out debt, but then there are the stragglers that if things go south, the markets might not be as open to letting them borrow cheaply, and they can't necessarily afford to pay higher rates. So I think that's something that we're watching is those lower tier, the single B and lower names, a lot of the names that, get swept up in this and really get hurt.
And I mean, just to piggyback on that, I mean, not to steal the show from you, but there's a little bit of a bifurcation, right? Certainly where you do have those weakest borrowers who've maybe already been through an LME or two, right? And what we are seeing increasingly, and this is independent of rates, right? They're just falling over the ledge at this point, right? Because they've already been through LME 1, maybe LME 2, and they can't get there anymore. But everybody else in the market right now, the market's, as Rob alluded to earlier, absolutely wide open. So at least in this current climate, doesn't really matter what the Fed does.
And so let's see what the audience thinks the Fed will do.
Ooh.
A cut.
Ooh,
okay, so a much more favorable environment for some of these heavily indebted borrowers, but we will have to see. Still lots of questions over inflation and such.
See, if we offered hold, I'm sure hold would have been
noted for the next panel. So I want to take this back to the AI infrastructure build out because every debt market is being tapped so heavily for this. And the expectation, as people have talked about earlier today, is to just see that ramp up, right? We're going to see more and more debt to build out AI data centers and buying chips and things like that. But will demand actually keep up with supply? Like, is there enough demand from investors to keep doing this? And Rob, I think you have very strong opinions on this. So.
Yeah, I think it's...
Think about the Rushmore.
It's pretty clear.
That's where people are traveling, mind you.
We're hearing different adjectives, unprecedented, unheard of, record, the type of demand that we're seeing for AI infrastructure. It's somewhat mind-boggling. These numbers are so enormous, it's hard for people to get their hands around. And that's why access to capital is so critical. Some of what we're seeing, though, may be a little bit of front-loading. Everyone's trying to get as much done as possible, as soon as possible, because they want to capitalize on the monetization upside as early as they can. I actually think it's going to take a few years. It's probably not going to be until 2028 until we see an inflection point on adjusted free cash flow turning positive again for most of these companies. The beauty, though, as you go up the curve in terms of credit quality, is that they have lots of triggers to pull. If you're a high yield company, there's not a lot of savings that you can take away from, say, cutting dividends or share buybacks. But take a look at what the new paradigm that we're living in now is. Alphabet not only announced an $80 billion equity raise. If you weren't checking your Bloombergs this morning, they actually upsized it this morning to $84.75 billion. Companies that are issuing equity are unlikely to be buying back a lot of stock over the next year or two. And what were most of these hyperscalers doing for the last handful of years? They had so much cash, all they could do was pay dividends and buy back stock. So pouring it into cash flow generating assets makes a ton of sense. So one of the ways you could actually save money, regardless of where rates are, is you can reduce your shareholder returns. That's not going to be through dividends, so it's going to be steady, but that's going to be through lower share buybacks. As you go down the curve, I do think there's a potential problem in high yield. Like Noel said, right now, the market for funding, it doesn't really matter if you have an ongoing business. You know, these bankers out on the left-hand side before, they'll figure out a way to get somebody to buy it. Like Rob Cohen said, you just sort of price it right. When they were asked, you know, are you full on these names? Are people getting full? No one's ever full on anything. It's all about price. You price something cheap enough, you're going to buy it. So the buy side always wants to say that they're full until they can get something a little cheaper. So to me, there's so many levers to pull, at least when it comes from a hyperscaler perspective, being able to raise money in the private markets, the public markets, alternative currencies. Now all of a sudden, you know, you throw in these massive equity potential raises, which are, to me, are purely opportunistic. It just says demand is continuing to far outweigh supply, both in terms of fundamentals as well as in terms on the investment side, is that come with more bonds, we want to buy them, and everyone wants to say that they're too tight, and they say we'll buy more.
And one interesting thing is I think the reason why some of these AI deals have done so well is because there is a lack of acquisitions. And I've been hearing for years that next quarter leverage buyouts will come back. We saw some very strong green shoots at the start of this year, especially with the EA buyout and a few other things. But lately that died down, although we have seen, you know, the Fertitta Caesars deal and also the potential People MGM deal, which are both in the casino sector. So can you speak to what those deals tell us about the potential for leverage buyouts coming back?
So Paul, this has been quite the week in gaming. And I think what's so interesting is, as you said, everybody's been saying, oh yeah, LBOs are coming back, they're coming back. M&A is coming back. Now we have seen M&A between equals, a lot of M&A between equals. Some that have panned out successfully, some that have been a little less so. Six Flags, for example, is one where they claimed they were going to reduce leverage. And so far, I'm waiting for when they reach that target that they've pushed out and increased. And so I think the key with the Caesars and the MGM situations, it's twofold. Number one, these are companies that have been doing different things to sort of segment themselves in an industry that is seeing a lot of changes. You know, there was mention of the prediction markets, or poly market just getting thrown around last speaker, and that is just indicative of the fact that the industry is changing, that federally they are looking at things differently for a very nascent part of the industry, and that could affect these guys. And so they're responding. And more so, for a company like MGM, they can't really delever so much more because everything's in sale leasebacks. But what they have been doing is they've been expanding to Osaka. They tried to expand in New York. They still have the Racino, but they decided to pull out to be a little bit more conservative from a cash perspective. Caesars has been focusing on deleveraging to sub 5 times for quite some time and has been not successful because they haven't been able to grow EBITDA. So it's not necessarily surprising to us that this is happening. In fact, we wrote a note a few months ago that talked to this effect that there's going to be more, especially in the leisure space, because this is sort of a later stage indication when you had such a run on a sector, is that then you start having the M&A to kind of keep the party going longer. So I'm a tad bit concerned only because it brings up memories of when companies like this went through large transactions in the past, Caesars in particular, but then there are a few other names that haunt us. And I think it's only a matter of time before those deals get announced as well. And is that a precursor then to some sort of shift in the credit cycle? I don't know. I don't think it's going to happen this year, but I do think that people are going to be watching those deals closely.
And in quickly in my space, I don't see any of that happening. When you could buy all these structured private deals, you know, all this capital is going to want to go to things where they have covenants, they have detailed structures where they can get similar style returns. So I think in the tech space, that's not a concern at all.
Yeah, and I think covenants is a kind of a loose term these days, as we're seeing.
That's true.
Because we are seeing with
structure
with these names in particular that lawyers are definitely getting involved in conversations, and there have been deals in the past that are very, very similar in that, where they've figured out ways to sort of skirt change of control provisions. They figured out ways to basically tell creditors that your covenants are worth nothing. So we're just going to do what we're going to do, and you're just going to have to be along for the ride.
And Noel, can you speak more broadly to whether you see leverage buyouts coming back in the second half of this year, and what could or could not cause that?
Yeah, I want to stay mindful of time because we got 2.5 minutes left. But so I'll answer it quickly, and I'll say I kind of look at it from a slightly different angle, which is to say, part of the catalyst behind this is the year of the LBO, this is the year of MBA, was partly driven by this is the year that PE is finally going to be able to exit some of their legacy positions and start to recycle cash. As long as rates are where they are, given where a lot of these capital structures were funded initially, it's very hard for them to get their numbers out on the back end, which means that they stay frozen, which means LBOs and M&As themselves stay relatively frozen. So that'll be my succinct answer to leave you 2 minutes.
Great. Well, for these last 2 minutes, I'd love to just hear from you. What do you identify as the biggest risk in credit markets coming up?
Wow.
Just if you have to pick one, the most important one.
Stagflation, which is probably, it's interesting because even as we're getting some of the inflationary data out, and we have sort of the K-shaped economy that Jody alluded to, Rob's part of the market, given the investments that they're making and the impacts that it's having on the broader economy, have sort of been keeping everything afloat. But if you're getting this sort of mid-3, low-4 type inflation number, and you do have a large swath of the market that's not growing, eventually you're going to get people kind of getting concerned and maybe getting concerned about rate hikes, right? And that would be this dynamic which we saw in 2022 and 2023 where people no longer wanted to own duration, right? So there was this whole flood out of duration which then flowed through markets and repriced everything. That would sort of be the scenario that I would be most worried about.
And Jody?
So beyond stagflation, I would say underemployment also is a component, because what we're seeing, and this is a conversation that we've had in the Princeton office where Noel and I hang out, is around the fact that you're not necessarily, labor is very strong, the labor market is robust, et cetera, et cetera, et cetera. But we are seeing that lower parts of the labor market, so lower income individuals, the hiring is actually pretty strong, but it's sort of mixed on the higher level. And what I'm mindful of is if we start seeing either unemployment or underemployment, and what that means when you're then faced with the inflation and the macro factors such as geopolitical risk and all the components, never mind the fact that we just have a whole completely new Fed. So I think that in a nutshell is basically everything we're dealing with these days, but I think that is where I'm sort of watching, because people are going to pull back on discretionary spending. And when they pull back on discretionary spending, that's, if you're talking 70% of the market is consumer spending, 30 to 40% of that is that discretionary component. That's a big chunk.
And I think the probability of having some major backup is extraordinarily low. But that being said, access to capital in my world is what's critical. So if there was some exogenous event, I don't think it's going to be driven by something in my space, but some outside event that closes capital markets, that would have a major impact.
Got it. Well, that is the panel. Thank you for your time, and lots of things to think about going into the rest of the year.
Thank you all for attending. I just want to say I'm not going to stand between you and lunch. Thank you for being here, and enjoy lunch in the other room. Take care.